Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today we're digging into the strategy of John Neff, who is, without a doubt, one of the most successful fund managers in history, and yet you might not even know his name. He ran the Windsor Fund for 31 years, and folks, his record is just legendary. Okay, so check this out. For over 3 decades, from 1964 all the way to 1995, Neff's fund didn't just beat the market. It beat it by an average of 3.15% every single year. Now, that number might not sound huge, but when you compound that over 31 years, it's an absolute world of difference. To give you some perspective, that 3% edge is enough to double an investment's value over time, on top of whatever the market itself returned. It's just staggering. And look, this wasn't some lucky streak. The investment expert Charles Ellis put it perfectly. What's so amazing is that Neff managed this incredible feat with a portfolio that was often considered less risky than the market as a whole. This was all the result of a really disciplined, repeatable, and frankly, often misunderstood philosophy. So the big question is, how on earth did he do it? Well, in this explainer, we're going to break his whole approach down into 4 key parts. First, we'll get into his core philosophy, what he called the low PE approach. Then, we'll dive into his super specific 7-point checklist. After that, we'll explore the mindset you need to pull this off. And finally, we'll look at his simple rules for knowing exactly when to sell. All right, so first things first, it's really important to get this. Neff didn't really like the common labels, value investor, contrarian investor. He thought they were just too broad, too vague. No, he had a much more specific, almost mechanical starting point for his entire process. He said it himself right there. He was a low PE investor, period. And this wasn't just some casual preference. It was the absolute bedrock of his entire discipline. His focus was laser sharp. Find and buy unpopular, out-of-favor stocks that were trading at low prices compared to their earnings. That was his world. That was his hunting ground. This really paints the picture, doesn't it? While most of the market, most other fund managers were chasing the hot, fashionable stocks, the can't-miss companies everyone was talking about, Neff was deliberately digging through the market's bargain bin. He was looking for the overlooked, the unloved, the forgotten companies. And his whole strategy, his entire universe, started with this one simple ratio. The PE ratio is just a quick way to see if a stock's price is high or low compared to the actual profits the company's making. For John Neff, a low PE was the essential first step. It was the ticket that got a stock in the door for him to even consider it. But here's the thing. A low PE was just the ticket for admission. It got a stock on his radar, but it absolutely did not guarantee he would buy it. To separate the true bargains from the companies that were, cheap for a very good reason, Neff then applied this incredibly rigorous 7-point checklist. This checklist was his North Star for every single investment, and it goes so far beyond just a low PE. For instance, he demanded real, fundamental growth of at least 7%. He wanted to make sure the company was actually moving forward, not just sitting there. He wanted what he called yield protection, a dividend that not only paid you to wait, but also acted as a kind of safety net for the stock price if things got rough. This whole checklist was his secret weapon against buying so-called value traps. Now, this is one of Neff's most powerful and kind of brilliant tools. It's a metric he basically came up with himself. He'd take a company's earnings growth rate, add its dividend yield to get what he called a total return figure. Then, and this is the key part, he divided that total return number by the company's PE ratio. And his goal was so simple. Find stocks where that final number was at least double the market average. He was literally systematically looking for twice the bang for his buck. And here's a perfect example of how this plays out. Let's take a typical market darling, a hot growth stock. It might have great growth, sure, but you're paying a massive PE of 40 for it. That gives you a total return to PE ratio of just 0.5. Now compare that to a typical Neff target. Yeah, the growth is a bit slower, but you're getting a nice dividend and you're only paying 8 times earnings for it. The result? A ratio of 2.0. That's 4 times the value for your money. This is exactly what he meant by a superior relationship of total return to price paid. But the numbers and the checklists were really only half the battle. I mean, anyone can run a stock screen. The other half, the part that's so much harder to copy, was purely psychological. It took a very specific kind of mindset to do what he did. This quote just says it all, doesn't it? He wasn't just okay with owning what he called ugly stocks. He actively embraced it. The companies that other investors were running away from, the ones with terrible headlines. That's where he went looking. He truly believed that the best opportunities were found in the places that made everyone else uncomfortable. So here's the crucial idea. It was a two-part system. His analytical checklist, that was his judgment. That's what allowed him to spot a mispriced opportunity in the first place. But then came fortitude. That's the psychological toughness, the sheer courage that allowed him to actually buy that stock. And more importantly, to hang on to it while the rest of the world told him he was wrong, sometimes for years. And this story, his investment in Citicorp, is just a perfect example of that fortitude and action. He bought it back in '87 when everyone was absolutely terrified of its bad loans. Then the stock got hammered in the 1990 banking crisis. I mean, can you imagine the pressure to sell? But his analysis hadn't changed. He held on, and by 1992, his conviction paid off with massive returns. All right, finally, let's talk about selling. Because finding and holding a great investment is really only half the job, right? A great trade isn't truly finished until you know the right time to get out and actually lock in those profits. Neff was so aware of this, he completely avoided that classic mistake so many investors make, falling in love with a stock that's done well for them. Instead, just like his buying process, his selling strategy was simple, it was unemotional, and it was incredibly disciplined. I mean, look how refreshingly simple this is. He had two reasons to sell, and only two. First, sell if the fundamental story changes, if your original reason for buying is just not true anymore. You admit you are wrong, you cut your losses, you move on. And second, sell when the stock hits your price target. That means the market finally sees the value you saw and it's not a bargain anymore. In other words, it boils down to this. Sell if you were wrong, or sell if you were proven right. That's it. When you look back at John Neff's incredible 31-year record, it really makes a powerful case, doesn't it? In this noisy, trend-chasing world of investing, where everyone is jumping on the next hot thing, his success really suggests that maybe, just maybe, the quiet, disciplined, and often lonely path of buying quality when it's out of favor, well, that might just lead to the greatest and most lasting rewards of all. So, when you think about the origin story of a Wall Street legend, you probably picture a corner office, maybe an Ivy League degree. Well, this one starts on the frozen shoulder of a highway. It's an incredible story that begins with a thumb, a backpack, and a one-way trip east. Let's set the scene. It's January 1955, and this is our guy, John Neff. He's fresh out of the Navy, just got his college degree, but he has zero connections. No job offers waiting for him. All he has is a goal: get to New York City for a few job interviews in the financial capital of the world. And his way of getting there tells you everything you need to know about where he was starting from. So, what was his entire travel budget? $20. And no, that wasn't for a bus ticket or a train fare. That was for everything. $20, a small bag with a change of clothes, and maybe a snack to get him all the way from Ohio to Wall Street. This wasn't some fun road trip. This was a mission born out of pure necessity. All right, so let's get into it. Section 1, A Hitchhiker's Guide to Wall Street. This first part of the story is all about the incredible grit it took just to show up at the starting line. This right here lays out the whole 600-mile journey. I mean, just imagine it. He starts on a freezing ramp in Toledo, catches a ride with a trucker all the way through Pennsylvania, and then gets dropped off at a truck depot in Jersey City close to midnight. It took 16 hours and 5 different rides before he finally made it into Manhattan and checked into the YMCA. That was his grand arrival in the Big Apple. You know, 16 hours on the road gives you a lot of time to talk. So he's chatting about baseball. He's admitting his investing knowledge really just comes from a couple of college classes. He even gets a whole history lesson on Texas politics from one driver. And when people asked him what he was up to, his answer was so simple, so humble. I'm just going to New York to look for a job. Okay, Section 2, The Big Apple, 1955. So after that grueling trip, he's finally there. But the city he's arrived in and the industry he's about to walk into, it's a completely different world from the one we know today. Just take a second to really think about this contrast. On one side, you've got Neff's reality, this long, dark walk, a cheap room at the Y, just a small bag to his name. And on the other side, you have the sheer weight and history of Wall Street. Federal Hall, where George Washington himself took the oath of office. The J.P. Morgan Bank, still physically scarred from a bomb attack decades earlier. It's the ultimate David and Goliath setup. And that brings us to Section 3, a world of ticker tapes. The Wall Street that Neff walked into was, well, a totally different animal. The source material actually calls it a sleepy and antiquated business, and you're about to see exactly why. What's so wild about this is just how physical everything was. Forget high-frequency trading. We're talking about literal paper ticker tapes that would print out so slowly they'd actually fall behind the market. Orders were written on paper slips and then shot across rooms in pneumatic tubes. And prices, someone had to manually update them on a chalkboard. It was this clunky, mechanical, almost industrial process. And this chart, wow, this really puts the scale of it all into perspective. On a busy day back in 1955, maybe 5 million shares would get traded. Today, we're talking over 5 times billion. That's not just double or 10 times more. That's 1,000 times more. It is a completely different universe of speed and volume. And it wasn't just the tech. The players were different too. Wall Street in 1955 was pretty much an exclusive club. It was dominated by stockbrokers from wealthy, well-connected families. The big institutional investors, like pension funds, were super conservative. They basically just stuck to bonds. Now, this didn't just make it old-fashioned. It meant the whole industry was built more on who you knew and tradition, rather than on rigorous, independent thinking. And that created the perfect opening for an outsider like John Neff. Which brings us to Section 4, the Wall Street Gauntlet. So now that we've set the scene, it was time for Neff to actually face his interviews. This is what that whole 600-mile journey was for. So, guided by a magazine article and a bit of encouragement from a professor, he had lined up interviews at 4 of the biggest brokerage firms around. He walked in there with his Navy experience, a couple of finance classes under his belt, and all the confidence of a guy who used to sell shoes. He really thought he did pretty well. So what were the results? Well, he wasn't exactly a smash hit. Merrill Lynch and Blythe both turned him down flat. Smith Barney was kind of wishy-washy, said they'd call him back for more tests. And then came the total curveball from Boschie & Co. They rejected him for the stockbroker job. They actually said his voice lacked authority. But then they offered him something totally different, a job as a securities analyst. So let's get into Section 5, an analyst in the making. Because this moment of rejection, it would end up being the single most important pivot of his entire career. It's what forced him to figure out what he was truly built for. His own words really say it all. At first, he was bummed out. He had hitched all the way to New York to be a stockbroker, right? But the more he thought about it, this huge realization started to dawn on him. The analyst role, that was actually a way better fit for who he was. Let's break down what was going on in his head. The stockbroker path on the left, that was all about sales and hand-holding clients, what he called a stultifying routine. But the analyst role on the right, that was about intellectual curiosity. It was about plying a trade. It wasn't about pushing stock. It was about truly understanding a business. So what does he do? He leaves New York. He doesn't hang around waiting for Smith Barney or try to argue with Bache. He treats himself to a Greyhound bus ticket, no more hitchhiking for him, and heads back toward home, where he accepts an analyst job in Cleveland. He left the Big Apple not with the job he thought he wanted, but with the career he was truly made for. And this is where it all clicks into place. Section 6, the undervalued path. See, his crazy, unconventional journey wasn't just some random biographical detail. It became the very foundation of the legendary investment philosophy he would build his life on. He actually made this connection himself years later. He pointed out that back in 1955, the top college grads weren't running to Wall Street. They were all going to big industrial companies like Ford or General Electric. The investment business itself was out of favor. It was undervalued, just like the very stocks he would later build his entire career on finding. And that brings us to the formal definition of the style he would become famous for. Contrarian investing. It's all about looking past what's popular, looking past the hype, and finding real value where everybody else just sees problems. His own career began exactly this way. He chose an undervalued career path and made it a success long before he ever started applying that same logic to the stock market. So let's just trace that path one last time. A legendary career starts with a hitchhiker's thumb and a $20 bill. He walks into this antiquated old-school Wall Street and pretty much gets rejected. But that rejection leads to this amazing moment of clarity, where he finds his true calling wasn't in sales, but in analysis. His entire experience shaped his philosophy: look for the value that everyone else is too quick to ignore. And that kind of leaves us with one final thought. John Neff found his undervalued opportunity back in 1955 by choosing a career that most other people were overlooking. So the question for all of us is, in a world that is constantly chasing the next big trend, where are the undervalued paths and overlooked opportunities that are just waiting to be discovered today?
When you picture a legendary investor, you're probably thinking Wall Street, right? Ticker symbols, a big corner office. But for John Neff, one of the absolute greats, the philosophy that made him a legend wasn't forged in some boardroom. Nope, it was forged in the heat and the grit of a Michigan basement, way before he ever even saw a stock chart. And that right there is the heart of it all. It's such a powerful idea, isn't it? It's all about perseverance, about having the guts to stand your ground when literally everyone is telling you you're crazy. And as we're about to see, this mindset was basically baked into his DNA from a super young age. It's way more than just a stock tip. It's a whole way of looking at the world. So this is where the story really begins. Just imagine this for a second. You've got a 5-year-old John Neff, and he's watching his grandfather stoke this old coal furnace. It was a hot, filthy, relentless job. His granddad would just shovel coal onto this treadmill thing that fed the fire, and he'd stick with it until the job was done, all to keep the family warm. Neff had a name for this, grubbing it out. And that single image of tough, unglamorous work, that became the bedrock of his entire life. Okay, so here's our game plan for this explainer. We're going to trace exactly how that grubbing it out mindset got built, piece by piece. We'll start with the furnace itself, then we'll get into his really unconventional childhood, his very first lessons in how markets work, that incredible work ethic, and then finally, how it all clicked together to create the mind of a true investing legend. All right, so let's start with that furnace. See, Neff was convinced that the building blocks of his success had nothing to do with financial formulas he learned in a classroom. They were character traits, plain and simple. Traits that were hardened and shaped by his early life, kind of like that coal being fed into the flame. What's so fascinating here is that these are the qualities Neff himself pointed to. Perseverance? Well, that came straight from the furnace. Sympathy for the woebegone, which you can see how that would later translate to seeing value in beaten-down, unloved stocks. Frugality, stubbornness, and just being willing to go against the grain. These weren't just little quirks of his personality. For Neff, these were his essential tools for winning at the game of finance. So, where did all these qualities actually come from? Well, his early family life was anything but stable. But here's the thing, instead of breaking him, all that constant change actually forged this incredible foundation of resilience and self-reliance. Just take a second to let this timeline sink in. His parents split up when he's only 4. He and his mom move in with his grandparents. Then, the guy who stoked that furnace, the man providing for the whole family, dies when Neff is just 8 years old. So the family gets uprooted all over again. I mean, that is not an easy start for any kid. And here's the crucial twist. You'd think with all that instability he'd feel lost, but Neff said he never felt like a product of a broken home. Why? Because his mother and grandmother created this incredibly comfortable and supportive bubble around him. And that security is what allowed his self-confidence to just blossom. It gave him the freedom to develop that tendency to flout convention that would become his secret weapon down the road. Okay, now we get to his first ever exposure to the raw, nitty-gritty principles of business. And wow, they could not have been more different from each other. These weren't lessons from some boring textbook. These were real, gut-punch experiences with massive success, spectacular failure, and the totally wild psychology of markets. This contrast basically gave him 2 powerful and completely opposing life lessons. On one side, he saw his relatives' food city supermarkets. They were innovative, totally focused on giving people a bargain, and they were wildly successful. The lesson there was pretty clear. A smart, value-driven business works. But on the other side, he had to watch his grandmother's life savings get poured into his Uncle Dodd's failing store, a venture that just crashed and burned. And watching his uncle's business completely collapse taught Neff 3 incredibly harsh but priceless lessons. First, his grandmother's emotional desire to help her son totally clouded her financial judgment. Second, and this is a huge one for any investor, just because something is down and out does not automatically make it a bargain. And third, a more personal but equally important lesson about discipline. But maybe the most perfect little miniature lesson in how markets really work happened on a school playground. This had nothing to do with family or business. This was just pure, raw market psychology playing out among a bunch of 5th graders trading baseball cards. And what he saw was just total mania. This emotional wave just swept across the playground.
Kids weren't trading cards based on how good a player actually was. No, they were bidding based purely on the hope that they could flip it to some other kid for more. All of a sudden, these hot cards were worth 3, 4, even 5 other cards. He was literally witnessing his first speculative bubble, right there on the blacktop.
And there it is, the profound takeaway that would guide him for his entire career. Even as a 5th grader, he just knew that overpaying felt wrong. He saw it with his own eyes. The hottest, most popular cards, the ones that shot up the fastest, were the exact same ones that inevitably crashed the hardest. This was his first intuitive gut feeling about how market bubbles work. But these weren't just abstract ideas for Neff. His deep understanding of value was forged by a really intense, real-world work ethic. He wasn't just watching value from the sidelines. He was learning what it really meant through pure, hard grind. Starting at age 11, Neff earned all of his own spending money and bought all his own clothes. Just think about that for a second. He kicked it off with the paper route, then he leveled up to caddying at a pretty exclusive golf club, and by the time he was in high school, he was basically running a convenience store and ice house in Texas. This was not a summer job for kicks. This was work, plain and simple. And to put this all into perspective, get a load of this number. During the summer of 1944, when he was just 12 years old, Neff was pulling in $40 a week from caddying and his paper route. That was almost as much as a full-time adult factory worker was making during World War II. It's just a staggering figure that tells you everything you need to know about his drive. So how does this all come together? Well, that intense work ethic didn't just teach him the value of a dollar, it cemented his entire worldview. All these different experiences, the Michigan grit, the family chaos, the playground economics, the relentless grind, they all started to merge into this one-of-a-kind, convention-defying mindset that would eventually make him millions. When his family picked up and moved to Texas, he never quite fit in. His classmates even nicknamed him Brooklyn because of his northern accent. He admitted he was a terrible student. His mind would just wander after 10 minutes of any lecture. His real education was coming from the world around him, from his jobs and, get this, from radio shows. Think about it. Radio forces you to create your own mental pictures, to analyze stories without anyone telling you what to think or see. It was the perfect training ground for an independent mind. And this, right here, is Neff's own perfect summary of who he became. The Michigan substance, that's the furnace-stoking, grub-it-out work ethic. That's the part that understands true underlying value. It's what allowed him to look at a company everyone hated and see potential, not just problems. But the Texas BS is just as important. That's the flair, the confidence, the unique perspective of an outsider who was totally comfortable being different. It was this mix that gave him the courage to act on his analysis, to stand all alone and argue not just with popular opinion, but with the entire stock market. So we end up with this question. John Neff's story really suggests that the true foundations of being a great investor, things like perseverance, contrarian thinking, and a deep, gut-level understanding of value, they aren't always found in finance classes. Sometimes they're found in a dirty basement, on a playground, and in the simple, hard-won lessons of earning every single penny yourself. So how does a kid with absolutely no direction, no interest in finance, end up becoming one of the greatest investors of all time? Well, today we're going to dive into the strange, winding road of John Neff's early life. We're going to uncover the unexpected, basic training that secretly forged a Wall Street legend long before he ever even saw a stock ticker. And that, right there, in Neff's own words, is the real kicker of this whole story. His journey didn't start with some grand ambition or a master plan. No, it started from a place of knowing literally nothing about it. This is the story of how a bunch of seemingly random events came together to build an absolutely unshakable foundation for success. All right, so here's how we're going to trace his path. We'll start at the beginning with his kind of aimless days right after high school. Then we'll get into his first real job and a pretty complicated family reunion. After that, we'll see how the U.S. Navy became this totally unlikely classroom for him. Then we'll explore how games of chance taught him about finance. And finally, we'll meet the mentor who helped him put all the pieces together. Okay, so picture this. John Neff, fresh out of high school. He is not thinking about a career. He's not thinking about his future. He's just trying to figure out where he's going to sleep that night. His journey starts not with a bang, but with this profound sense of instability, just bouncing from one temporary spot to the next. I mean, this timeline right here really shows you just how adrift he was. He graduates, he goes to his great-aunt Lou's house, and he lasts a whopping 2 days.
Apparently, he was a little too good at sharing family gossip, and he was politely shown the door and dropped off at the local YMCA. This was not a launch pad for success, it was just a place to land for a bit.
But, it's funny, even in this totally aimless period, a really critical lesson just kind of finds him. His Uncle Al would tell him these stories about barely surviving the massive financial panic of 1893. And Neff didn't just hear a family story, he saw a perfect example of groupthink. That's when a whole crowd gets swept up in a panic and starts making the same irrational decisions all at once.
And this right here, this became the absolute bedrock of his entire philosophy. While everyone else saw total chaos and fear during that panic, Neff, looking back on it, saw opportunity. He took this idea to heart. When everyone else is panicking, that is the exact moment a smart investor should be looking to buy. And just like that, the first pillar of his contrarian mindset was locked in.
So Neff's life finally gets a little bit of structure when he lands a job at a jukebox factory. But just as he's starting to find his footing, his past literally walks right back into his life. The father he hadn't seen since he was 4 years old just shows up.
So at this jukebox factory, he's pulling in a modest $60 a week. Now that is not a lot of money, even for the early 1950s. But what Neff did with that money, well, that's what's truly remarkable. It tells you everything you need to know about his character.
I mean, just look at this. Even on that tiny salary, his natural frugality and discipline just completely took over. He somehow managed to put almost half of his income straight into the bank. This wasn't some strategy he read in a book, it was just who he was. And this ability to save and live below his means, it would be absolutely crucial later on.
Now his father, what a complicated guy. This slide really breaks it down. The reunion was tough. As a person, his dad was demanding, often bitter, just a difficult man to be around. But as a businessman, he was like a totally different person, honest to a fault, a brilliant salesman, and an unbelievable bargainer. Neff was smart enough to separate the two and learn from the businessman, even when the man himself was hard to deal with.
And the lessons he learned were pure gold. Working for his dad selling lubrication equipment, Neff picked up 3 rules that would define his entire investment strategy. First, find a boring business, because boring doesn't attract a lot of competition. Second, the profit is made when you buy, not just when you sell. And third, you have to bargain like crazy to get the best price. He was learning value investing right there on the factory floor.
So Neff decides he needs a change, and he enlists in the Navy. But his military career, well, it was anything but conventional. It turned into another one of these accidental classrooms, where the most important lessons had nothing to do with fighting at sea and everything to do with the stock market.
Before he even left for boot camp, his father makes him this incredible offer. It was basically a risk-free introduction to the stock market. He told John to take his savings, buy shares in a company connected to the family, Aero Equipment, and he promised to cover any losses. For a natural-born bargainer like Neff, this was a deal he simply couldn't refuse. And just like that, he was officially an investor.
His Navy career was almost comical. He went from boot camp to airman school, then to basic electronics school, then to advanced electronics school. All told, he spent about 14 months of his 24-month enlistment sitting in classrooms. He became an expert on the electronics inside fighter jets, but he never once set foot on an actual ship. This career, though, gave him one very important thing: a lot of downtime.
So what does a sailor with a ton of time on his hands do? He observes, and what he saw in the poker games in the barracks, well, that gave him one of the most profound insights of his entire basic training. He started to notice a pattern. Right after payday, poker games would pop up all over the place. A day later, only 1 or 2 were left, and he realized the money always migrated to the same few disciplined players. They were the ones who knew the odds, they were patient, and they only made big bets when the numbers were stacked in their favor. It was a perfect metaphor for successful investing. So during all this downtime, his curiosity just took off. He got his hands on a booklet about investing and just started teaching himself the basics. He even wrote to his father to ask if his Aero Equipment shares were common or preferred stock. And when he learned they were common, it was this light bulb moment. He understood for the first time that he owned a real piece of a business, sharing in both the potential rewards and, yeah, the risks.
So you add all these experiences together, the aimless wandering, the hard work, the Navy, and they created this whole new level of maturity and motivation in him. The same kid who was a totally unremarkable high school student, enrolled in college on the GI Bill, and just became an absolute superstar. He graduated summa cum laude with the highest honors and was even named the outstanding student of finance. He had finally found his passion.
So, at this point, he had all the raw materials, that contrarian streak, the discipline, a real gut feeling for value. But the final piece of his training came from a mentor who would give his passions some structure, some theory, and a crystal-clear direction.
At the University of Toledo, he takes this class with a Dr. Sidney Robbins, who was a student of the legendary Benjamin Graham. And Robbins was the one who finally revealed the real nuts and bolts of fundamental analysis to Neff. He taught him to look past all the market noise and focus on the real numbers that actually drive a business: sales, earnings, cash flow. For Neff, it was a total revelation.
But Professor Robbins gave him something maybe even more important than the technical skills. He gave him confidence. Just like this quote says, he convinced Neff that you didn't have to be born into some wealthy East Coast family to make it on Wall Street. If you had the brains and the work ethic, that world was open to him too.
And so, by the time he was ready to head to New York, John Neff had put together his complete toolkit. And it wasn't forged in some fancy MBA program, it was forged in the real world. He learned contrarianism from a family story, frugality from his own nature, the importance of value from his father, the power of probability from poker games, and the language of fundamentals from a great mentor.
John Neff's story is just this powerful reminder that the most important lessons often come from the most unexpected places. It was not a straight line, but every single detour, every odd job, every chance encounter, it was all a crucial piece of his education. And it kind of leaves you with a question to think about. What's the unexpected basic training that has shaped who you are today?
Before John Neff became the investing legend, the guy who just crushed the market for 3 whole decades, he was just a young analyst. He was full of confidence from his classes, sure, but really short on actual real-world experience. So today, we're not talking about the finished product, the icon you see on magazine covers. Nope, we're talking about the making of the legend. We're going to rewind the clock back to his formative years from 1955 to 1963 to really see the trials, the humbling failures, and the crucial lessons that built his iconic investment philosophy from the ground up.
So, here's how we're going to break down his journey. It's kind of like a 5-act play. First, we'll see him take his first steps on the scene as a confident, but let's be honest, pretty green analyst. Then, we'll watch as he's thrown into a trial by fire that could have ended his career before it even started. We'll dig into the tough lessons he learned in the trenches, see the moment his contrarian calling really clicked, and finally, watch as he sets his sights on a new horizon, a move that honestly set the stage for everything that came after.
All right, let's set the scene. It's January 1955. A young John Neff, degree in hand, lands his first real professional gig. But it's not on Wall Street. It's at the National City Bank in Cleveland, Ohio. And he was absolutely 100% convinced he was ready to take on the entire world of finance. And, as Neff himself admits, he showed up with a pretty healthy dose of confidence. Maybe a little too much. He had all the academic knowledge, right? He knew the theories, he knew the formulas. But he was about to get a masterclass in the fact that the real world of investing is a totally different and much wilder beast than any textbook could ever prepare you for. So what was he working with when he started? Well, his toolkit was all intellectual. First off, he had this natural skepticism, just a deep-seated need to question what everyone else just accepted as true. Second, he had the framework from his professor, Sidney Robbins. And finally, he carried around this well-worn dog-eared copy of The Great Crash, which was a constant reminder of just how crazy and irrational markets can be. This was the foundation he was about to build his entire career on. So with that intellectual toolkit, he was about to face his first real test. And at the bank, there was no gentle introduction, no hand-holding, not at all. Neff was thrown immediately into a situation that was either going to make him or break him, a true trial by fire. I mean, just look at this list. The bank only had 6 analysts on staff, so they just carved up the entire investment universe by 6. Almost overnight, Neff was supposed to become a world-class expert on everything from the complex chemistry of polyvinyl chlorides to the super intricate balance sheets of finance companies. The learning curve wasn't just steep, it was a vertical cliff. And here's the kicker. To get a handle on those 6 massive industries, Neff couldn't just pull up a data terminal or run a stock screener. His reality was pure, grueling, old-school legwork. We're talking about building statistical sheets by hand with a pencil and paper, digging through dusty old trade publications, and getting stock quotes by literally watching a physical ticker tape. It's a world that's almost impossible for us to imagine now. So here's the setup for his first big moment. He steps into the professional world right after the market had been absolutely on fire, soaring 45%. Optimism was everywhere. The Dow was hitting new highs. It really felt to everyone like the party would never, ever stop. So what does our young, skeptical analyst do? Well, armed with his book about the 29 crash and that cautious mindset, he does what almost no one else would dare to do. He goes directly against the herd. Just 6 weeks into his new job, he walks into his boss's office and basically declares that the market looks way too frothy and is headed for a major fall. A really bold contrarian call, right out of the gate. And he was totally, completely wrong. The market didn't crash. It kept right on climbing, ending the year up another 17%. So his first major professional prediction, a total embarrassing flop. Luckily for him, he was new, so his voice didn't carry much weight, and no one acted on his warning. But for Neff, man, this was a huge lesson. Trying to predict the entire market is a fool's game. The real insights come from the bottom up, not the top down. You know, being that publicly wrong could have absolutely shattered his confidence. But for Neff, it did the exact opposite. It forced him back to the drawing board, making him determined to build his investment process not on big, sweeping market predictions, but on a rock-solid bottom-up foundation of analyzing individual companies, one by one. So, humbled, he went back to the basics and just doubled down on the real work. He developed this meticulous 3-step method. First, you devour every single piece of information you can find, annual reports, trade journals, anything. Second, you painstakingly build your own statistical sheets by hand so you truly internalize a company's performance. And finally, you use that deep knowledge to ask management the tough, insightful questions that other people weren't even thinking to ask. And this, right here, this is the core of what he was starting to figure out. He truly believed that this manual, nitty-gritty work, the kind of stuff you can't just outsource to a computer or an algorithm, was the only way to really understand a business and get an analytical edge. This deep, fundamental analysis would become the absolute bedrock of his legendary success. But, you know, it wasn't just about the numbers. Something else happened that really lit a fire under him. He was on a trip to a Ford plant with a veteran auto analyst from a big New York firm, and this guy shows up in a beat-up, dilapidated car. And in that moment, Neff realized that just being a brilliant analyst didn't automatically mean you'd be financially successful. He wanted more. He wanted to be the one making the final calls and reaping the rewards. So you've got this ambition, this natural skepticism, and this big, early failure. It all starts pointing him in one direction. He was beginning to find his true calling as a contrarian, and lucky for him, he found a mentor who spoke his language. So what are we even talking about with contrarian investing? Well, at its core, it's just the art of zigging when the rest of the market is zagging. It means you're systematically buying what's unloved, what's unpopular, and what's out of favor, and you're selling what's popular and expensive. It's a lonely path, for sure, and it takes immense conviction and a willingness to look wrong for a little while to be right in the long run. And lucky for Neff, he found the perfect partner in crime for this lonely path in his colleague Art Bonus. Bonus was this brilliant, kind of quirky economist who was, as Neff put it, contrarian to his marrow. His whole philosophy wasn't about arguing with other people. It was about treating the market itself as your opponent, this manic depressive thing whose logic was full of flaws you could exploit. This idea just clicked with Neff. And this really shows the intellectual battle that was brewing inside the bank. On one side, you had the official trust investment committee. These guys were super risk-averse. They loved recognizable, often overpriced blue-chip stocks. You know, the big, stable household names. On the other side were Neff and Bonas, the rebels, out there arguing with the marketplace and hunting for overlooked, unloved value. It was a fundamental clash of cultures. And then Neff got his chance to prove his way could actually work. Instead of the usual long 7-page report that nobody ever read, he made the investment case for Polaroid on a single, powerful, data-driven page. And to everyone's surprise, his clear, concise argument actually convinced the conservative committee. The stock took off, made the bank a ton of money, and gave Neff a huge victory that proved his entire bottom-up contrarian approach was the real deal. Okay, so that Polaroid win, that was huge. It was a major turning point. Neff had proven his skills, he'd honed his philosophy, and he was getting results. But with that mastery came a new and growing problem: deep frustration with the very bank that had taught him so much. He knew he could do more. And get this, while he's fighting all these battles at the office, he's putting his ideas to work with his own money. And the results were absolutely incredible. He turned a small grub stake of about $3,000 in 1955 into nearly $100,000 by 1963. I mean, this wasn't just theory anymore. This was undeniable hard dollar proof that his contrarian value strategy worked. Of course, people started to notice. He became the bank's youngest officer and even got an offer from the big-name firm Wellington Management. He actually turned it down at first. They just wanted another auto analyst, and he knew he was more than that. But by 1961, the frustration at the bank was just too much. He knew he'd outgrown their conservative culture. So he picked up the phone and called Wellington again. This time, the offer was different. They didn't just want an analyst. They wanted someone to help rescue a struggling equity fund. And that was it. That was the call he'd been waiting for. In 1963, John Neff packed his bags and headed to Philadelphia. He left the security of the bank behind him, closing the chapter on his 8-year apprenticeship in Cleveland. He was heading east to take over a struggling, overlooked fund that he would turn into the legendary Windsor Fund, and in doing so, cement his place in investing history. You know, Neff's early years really bring up this fascinating question. He spent 8 long years meticulously learning the rules of analysis, of business, of how corporations work. But his ultimate legendary success came from knowing which unwritten rules, like the market is always right, or you have to buy what's popular, were meant to be broken. So it really makes you think, in any field, where is that fine line between mastering the rules and knowing precisely when to break them?
Picture this. It's 1963. There's this mutual fund that was once a rising star, and now it's in a complete and total freefall. Its failure is so bad it's threatening to drag down one of the most respected names in the entire world of finance. The company is, frankly, desperate. They don't just need a manager, they need a detective. Someone to solve the mystery of what on earth went so catastrophically wrong. And what they got was a young, pretty much unknown securities analyst named John Neff. This is the incredible story of his baptism by fire and how he turned an absolute disaster into one of the greatest investment legends of all time.
So how in the world did he pull it off? Well, we're going to follow the clues just like he did. We'll start at the scene of the crime, this fund in crisis, and really get a feel for the legacy that was on the line. Then we'll meet our detective, John Neff, and watch as he conducts his investigation, lays out his solution, and in the end, completely rewrites the rules of the game.
All right, so let's set the scene. Our story begins at Wellington Management Company. The year is 1963, and the firm's big, aggressive equity fund, the Windsor Fund, isn't just having a bad year, it's a 5-alarm fire. It's blazing through their reputation, and absolutely everything the company has built for decades is hanging in the balance.
And it all comes down to this one really ugly number. In 1962, which was a tough year for a lot of investors, the Windsor Fund didn't just dip, it completely cratered. It lost a staggering 25% of its value. You can imagine shareholders were terrified, and they were heading for the exits as fast as they possibly could.
And just to put that 25% loss in perspective, take a look at this. The wider market, the S&P 500, it was down that year, sure, but only by about 9%. Windsor didn't just have a bad year. Its performance was nearly 3 times worse than the market average. It was a complete, unmitigated disaster.
And you know, this wasn't just some small problem they could wall off. The failure of the Windsor Fund, which was relatively small, was starting to poison the well for its massive $2 billion parent, the Wellington Fund. The company's salespeople were on the front lines, and they were starting to panic. The entire Wellington reputation, built so carefully over decades, was suddenly at risk.
Now, to really get why this was such a massive shock to the system, you have to understand the Wellington legacy. See, this firm wasn't built on reckless, high-flying risks. No, it was founded on the exact opposite idea, being careful, being prudent. This timeline right here, it really tells the whole story. Walter Morgan kicks off the original Wellington Fund back in 1928 with a super conservative mix of stocks and bonds. That cautious approach is exactly what helped it survive the Great Depression when so many others just vanished. But then you get to the 50s, and these high-growth, all-stock funds are the hot new thing. So to compete, Wellington creates its own equity fund, which eventually becomes Windsor. It flew high for a little while, and then boom, in 1962, it just crashed and burned in spectacular fashion.
And right into the middle of all this chaos walks our guy, a young, really ambitious securities analyst from Ohio. He gets hired by Wellington with no specific job description, smack in the middle of the Windsor Fund's meltdown. His name was John Neff.
So when Neff shows up, this is literally the only instruction he gets. No specific assignment, no clear title, just this simple, direct, and incredibly urgent command. Figure out what's wrong and make yourself valuable. The whole company was in trouble, and Neff's job was simply to find a way to help fix it.
You know, to really get inside Neff's head, you just have to hear this story about how he bought his family's house. His real estate agent showed him this really impressive neighborhood, but told him to stay away, saying the houses were all on a floodplain. Now, for most of us, that's a deal breaker, right? But for Neff, that warning, that was an invitation. He immediately understood that the perceived risk made a beautiful, fundamentally solid house available at a huge discount.
And this quote right here, it captures his entire philosophy perfectly. It didn't matter if it was a house in a floodplain or a stock that everyone else hated. Neff was just wired differently. He looked past the surface-level flaws to see the real, underlying value. Where other people saw risk and ran for the hills, he saw a bargain. And that was the exact mindset Wellington so desperately needed. So armed with this unique way of looking at the world, Neff's first real task was to perform an autopsy on the Windsor portfolio. He had to dig deep into the wreckage and figure out, with almost clinical precision, exactly what had gone so terribly, terribly wrong.
This was the big question, right? The $75 million question. It wasn't enough to just say, oh, the stocks went down. The company's directors needed to know why they went down, and more importantly, how to stop it from ever happening again. Neff's investigation was on.
Now, to understand Neff's diagnosis, we got to do a super quick breakdown of this core idea. A stock's price isn't just magic. It's really driven by two key things. One, how much money the company actually makes, that's its earnings, and two, how much investors are willing to pay for those earnings. That second part is the price to earnings, or PE multiple. A high PE basically means investors have sky-high hopes for the future. And this, right here, is the fatal flaw Neff uncovered. The Windsor Fund had been chasing these exciting story stocks, paying incredibly high PE multiples based on the hope of just spectacular future growth. But the second that growth didn't happen, or even just slowed down a little, investor confidence just evaporated. The PE multiples got totally crushed, and as a result, the stock prices were absolutely pummeled. So Neff boiled all his findings down to three big generalizations. First, the analysis that went into buying these stocks was just plain faulty. The companies missed their earnings targets by a country mile. Second, it wasn't just that growth slowed down. In a lot of cases, the company's actual ability to make money completely fell apart. And third, while the fund was actually pretty good at cutting its losses and selling, the real fundamental error was buying these fragile, high-expectation stocks to begin with.
Okay, so doing an autopsy is one thing, but it's pretty useless if you don't have a plan to prevent the same thing from happening all over again. So Neff didn't just diagnose the problem, he went to the board and presented a clear, disciplined philosophy for the fund's recovery.
And his solution was, well, it was brilliant, because it was basically common sense. He wanted to inject the conservative, careful DNA of the original Wellington Fund back into Windsor. He argued for focusing on predictable companies in predictable industries. He wanted to use Wellington's deep expertise in economic analysis to put a really high burden of proof on every single investment idea, and maybe most importantly, to judge a company's ability to make money even when things go wrong.
You know, it wasn't just the logic of his plan that won them over. It was his delivery. Neff was a total straight shooter. He didn't give them vague ideas, he presented cold, hard facts and a concrete solution. And for a board of directors that was panicked and totally adrift, his clarity and confidence were like a lifeline.
The impact of Neff's clear-eyed analysis was, well, it was immediate and it was profound. His work didn't just get him a pat on the back. It completely changed his career and really the entire structure of the company.
I mean, just stop and think about that for a second. In less than a year, the new guy, the analyst with that vague mission to make yourself valuable, had so thoroughly impressed the top brass that they handed him the keys to the very fund he had just dissected. He became the first person at Wellington ever to be given sole authority over a portfolio. The detective was now the sheriff.
And as we know, John Neff went on to manage the Windsor Fund for over 30 years, building one of the greatest track records in the entire history of investing. His whole legendary career was literally forged in the wreckage of that initial failure. And it really leaves us with a powerful question, doesn't it? When we're faced with our own crisis, do we only see the chaos? Or can we, like John Neff, see the opportunity to find clarity, to build a new path, and to forge our own incredible success?
Picture this. It's 1964. The Windsor Fund is, well, it's struggling. It's lagging the market and it is in desperate need of a major shakeup. So the parent company makes a pretty radical decision. They're going to hand over total control to just one person. This is the story of how that one manager took command and built an absolutely legendary track record by doing one thing, refusing to follow the crowd.
You can diversify yourself into mediocrity. Now that quote, it perfectly captures the whole philosophy of the man who took the helm, John Neff. See, for Neff, the goal was never to just play it safe. It was to make a real, tangible impact. And to do that, you had to take concentrated, high-conviction positions. He wanted to get some sizzle back into a portfolio that he felt had become, in his own words, pablum-like. I mean, what a direct shot at the conventional wisdom of the day.
All right, so let's dive into our first section, a new command. In May of 1964, John Neff was given sole authority over the Windsor Fund. And look, this wasn't just some promotion. It was a fundamental, ground-up shift in how decisions were going to be made from then on.
So before Neff, every decision at Windsor was made by a committee. And you know what that means. It often led to this watered-down, play-it-safe consensus. Neff's approach was the complete opposite. He wanted to be fast, flexible, and take these big, high-conviction positions, because he believed that to get great results, you had to be willing to stick your neck out.
And he wasted absolutely no time. Right away, Neff identified this predictable, totally underrated electronics company called AMP Incorporated, and he wanted to make a big bet. He saw solid, steady earnings growth in an essential, but let's be honest, unglamorous industry. It was the exact kind of value the market was overlooking. But there was a catch. Even with his shiny new authority, he still needed the stamp of approval from the very investment committee whose slow, consensus-driven nature he was trying to escape. So what did he do? Instead of facing the committee as a group where doubts could just feed on each other, Neff cleverly approached the key members one-on-one. He armed himself with what he called a salvo of exhaustive fundamental analysis to get their individual approvals. By completely neutralizing that group dynamic, he got his trade done. And from that point on, the buy and sell orders were his and his alone.
But Neff's challenges were far from over. I mean, you got to understand, the Windsor Fund was a tiny $75 million fund. That sounds like a lot, but not when you compare it to the firm's $2 billion flagship, the Wellington Fund. It was a rounding error. This meant all the firm's analysts were naturally focused on the big guy. So, after months of frustration, Neff proposed a compromise. Give him just one dedicated analyst, and he'd give up his claim to the other 6. Management agreed, and Windsor finally had the analytical firepower it needed.
Okay, part 2, forging a philosophy. With all those operational hurdles cleared, Neff could finally get down to business and start forging the unique investment framework that would define his entire career.
He called it measured participation. And you have to remember, long before asset allocation became this big buzzword, Neff was already practicing it. He was constantly weighing the potential of any single stock against the risks and rewards of other sectors, and then dynamically shifting his assets to wherever he saw the best opportunities. And he kept it beautifully simple. He narrowed the entire investment universe down into just 2 buckets, growth stocks and basic industry stocks. This second bucket also included what he called special situations. Companies going through some kind of major transformation, like a merger or a big corporate restructuring. No complicated breakdowns, just these 2 broad categories. That's it.
So, the big question, did it work? Oh, you bet it did. In his very first full year, 1965, Windsor delivered a dazzling 29.1% total return. To put that in perspective, he crushed the S&P 500's 12.1%. His focus on finding stocks with a future, not just a past, paid off immediately, and frankly, spectacularly.
But look, anyone can look good in a bull market, right? The real test of any strategy comes when things go south. And in 1966, the S&P 500 dropped a painful 10%. Windsor, though, it lost only 3.3%. Measured participation, it kept the fund out of the market's worst-hit areas, proving the strategy wasn't just about capturing the upside, it was about protecting your capital.
Part 3. The Go-Go Era. Now, just as Neff was hitting his stride, he came face-to-face with a new kind of challenge.
a market completely gripped by the wild speculation of the late 1960s. And suddenly, his disciplined approach started to look, well, boring and outdated.
On the trading floors, you'd hear this whisper, Tsai is buying. It personified the entire era. Gerald Tsai was the star manager whose funds were putting up just astronomical numbers. His influence was so massive that a mere rumor of his interest could send some obscure stocks soaring. These were what Neff called the adrenaline funds, and they had Wall Street completely spellbound.
The obsession was with so-called story stocks, companies built on little more than hype and the promise of some great future. Investors weren't buying fundamentals, they were buying a narrative. They were totally convinced they could always sell it to a greater fool for a higher price. It was a classic speculative bubble, the kind we still see pop up today.
So let's move to Section 4, Sticking to the Plan. As this go-go frenzy peaked, you can imagine the pressure on Neff to just abandon his principles and join the party. It became a mess.
And the criticism came from all sides. Even a friend at Goldman Sachs told Neff bluntly that Windsor was, quote, just not with it. In the eyes of the market, Neff's steady, value-driven approach was just old-fashioned. He wasn't playing the game that everybody else seemed to be winning.
And talk about pressure, it wasn't just external, it was coming from inside his own firm. Wellington Management actually merged with the managers of iVest, one of the hottest go-go funds of the era. So now Neff's own company was embracing the very philosophy he was resisting. It got to the point where he was sometimes buying the exact same stocks his new partners were selling.
A magazine cover story from January 1968 captured the whole sentiment perfectly. The title said it all, The Whiz Kids Takeover at Wellington. The perception was crystal clear. The old guard was out, and this new, aggressive style was in. Neff and Windsor were being left behind.
And that brings us to Section 5, Vindication and Victory. Because here's the thing about bubbles. They always burst. And when the go-go era finally ran out of gas, Neff's discipline wasn't just vindicated, it was triumphant.
When the music stopped, the reality was just brutal. Investors who had chased those adrenaline funds were lucky to get back 50 cents on the dollar. Fortunes that were made on paper just evaporated as one high flyer after another completely collapsed.
The vindication was just so dramatic. In 1969, right in the middle of all the wreckage from the crash, Neff attended a mutual fund conference. And the very same salesmen who had written Windsor off just a year earlier, they saw him, and they erupted into a spontaneous, glowing ovation. He had been right all along.
Yeah, the reports of Windsor's demise, as Mark Twain might have said, had been greatly exaggerated. While everyone else was nursing their wounds, the market collapse created what Neff called splendid investment opportunities for his fund, letting him scoop up great companies at absolute bargain prices.
And that's really the question that Neff's story leaves us with, isn't it? It's easy to have a plan when everything is working, but when the entire world is screaming that you're wrong, when even your own company seems to be betting against you, how do you find the conviction to stick to your principles? That, right there, is the enduring lesson from John Neff's command at Windsor.
The stock market can feel like just total chaos, right? New strategies, new fads, they pop up every single day. So wouldn't it be great to find a single durable style that just works? A strategy that completely ignores all that noise and focuses on one thing, finding incredible value. Well, one investor did exactly that, and let's just say the results were legendary.
Okay, let's just start with a number. A huge number that should really grab your attention. 5,546.5%. No, that is not a typo. For real. That was the total return of the Windsor Fund under the leadership of John Neff. This is what happens when you have a disciplined, consistent, and brilliantly simple strategy that you apply for over 3 decades.
And this quote from Neff himself, man, it just says it all. He wasn't out there chasing hot trends. He wasn't trying to be the flashiest guy in the room. His entire goal was to build a method that could stand up to any market climate, up, down, sideways, you name it, by sticking to a core set of principles.
So here's what we're going to do in this explainer. We're going on what I like to call the value hunter's journey. First, we'll look at the Windsor way to really understand his incredible results. Then we're diving deep into the core of his strategy, the low PE cornerstone. After that, we'll see what he demanded in terms of growth and yield. And then we get to his secret formula, the total return test.
From there, we'll see the whole strategy in action with some killer real-world examples, and we'll wrap it all up with the crucial investor's mindset you need to actually pull this off.
All right, let's start with the big picture, the Windsor way. John Neff took over the Windsor Fund way back in 1964, and for the next 31 years, he just put on an absolute masterclass in investing. He turned his fund into the largest equity mutual fund in the entire United States before it finally closed to new investors.
And check this out. The difference between his way and the regular market is it's stark. Imagine you invested just $1 back in 1964. With the S&P 500, that dollar would have grown to $22, which, is not bad. But with Neff, that same dollar would have exploded into $56. That's more than double the market's return. And he did it all the time, beating the market in 22 out of his 31 years. Come on, that's not luck. That's the power of a superior style. So you gotta be asking, how in the world did he do it? Well, let's get to the absolute foundation of his entire strategy, the low PE cornerstone. People called him a value investor, a contrarian, but Neff, he liked a much more direct label. He was a low price to earnings investor. Simple as that. This was his #1 tool for hunting down bargains. So what even is a PE ratio? Well, it's just the price of a stock divided by its earnings per share. But Neff had this brilliant analogy that makes it so clear. He said, think about it like you're shopping for cookies at the supermarket. Just looking at the price of 2 different bags doesn't tell you which one's the better deal, right? But the price per pound does. The PE ratio is the price per pound for stocks. It tells you exactly how much you're paying for $1 of a company's profits. Simple, but so powerful.
And this just makes the concepts crystal clear, using real companies from 1999. If you wanted to get $1 of Microsoft's earnings back then, you had to fork over $79. Oof. For a classic industrial company like Caterpillar, it was $12. And for a home builder like Beazer Homes, it was just $6. John Neff lived in that bargain basement, hunting for companies just like Caterpillar and Beazer Homes.
Okay, so this leads us to the crucial question. If these stocks are so cheap and nobody seems to love them, how on earth do they generate such incredible returns? See, it's not just about buying something cheap. It's all about what happens after you buy it.
This right here, this is the secret sauce. Take a look at stock A. Its earnings grow by 11%, but the market's opinion of it, its PE ratio, it doesn't change. So the stock goes up by 11%. Okay, fair enough. But now look at stock B, a typical Neff target. It has the exact same 11% earnings growth, but because it started out so cheap and out of favor, the market starts to wake up and recognize its value. Its PE expands from 8 all the way to 11. That combination of earnings growth plus the PE expansion, it just turbocharges the return to a potential 53%. That's the twofold punch Neff was always looking for.
But of course, not every cheap stock is a good investment. A lot of them are cheap for a very good reason, because they're just terrible companies. So Neff needed a filter, a way to separate the true bargains from the junk. And he had 2 other simple but really powerful demands.
First up, he demanded fundamental growth. The company absolutely had to be growing its earnings by more than 7% a year. This showed him there were real signs of life. Second, he wanted what he called yield protection. This meant he was looking for companies that paid a solid dividend. This gave him a cash return while he waited for the rest of the market to finally recognize the stock's true value. And I just love this quote from him. The dividend was the appetizer, the hors d'oeuvres. The main meal, well, that was that massive price appreciation he got from PE expansion. But getting paid to wait, that's a pretty fantastic deal. It also puts a sort of floor under the stock price and becomes a crucial part of the total return. So we've got the 3 core ingredients, right? A low PE, solid growth, and a protective dividend yield. But Neff needed a way to wrap them all together into a single elegant test, and this brings us to his secret map to value, a simple little formula he used to measure the bang for his buck on any stock he looked at. He called it total return, and the calculation could not be simpler. First, you just estimate the company's future earnings growth rate. Then, you add the current dividend yield. That sum, that's your total expected return. It represents everything you're getting for buying 1 share of that stock. Okay, so this final step is absolutely crucial. He created what he called the total return ratio. He took his total expected return and he divided it by the PE ratio he had to pay. And his goal was simple but so powerful. Find stocks where this ratio was at least double the market average. It was his way of making sure he was getting at least $2 of potential return for every $1 of PE he paid. This wasn't just a formula, it was a discipline. It was his ultimate yardstick for outstanding value, forcing him to stay objective and avoid that emotional trap of falling in love with a good story but a terrible price.
Theory is great and all, but let's see how this actually worked in the real world. Neff's career is just filled with these fantastic stories of finding treasure where everybody else only saw trash. These are tales from the value hunt.
Take ABC television back in 1978. It was a top dog in broadcasting, the leader in its field. And yet, for some reason, the market hated it. It hit every single one of Neff's marks. A tiny PE of 5, solid 11% growth, and a 4% yield. His total return ratio was just off the charts. The result? An 85% gain the very next year, as the market finally woke up to what was obvious.
Well, how about this one? Halliburton in 1982. The oil industry was in a major slump, and investors were running for the exits as fast as they could. Neff, he ran in. He found the premier company in the oilfield services space, with 16% growth potential and the nearly 5% yield, all for a PE of less than 5. The math was just too compelling to ignore. He called the outcome a gusher, and it produced absolutely championship-level returns.
And one more for you, Boeing, 1986. The consensus was totally negative because of a temporary little dip in earnings. Everybody was focused on the short-term problem. Neff looked right past it. While the market was fretting, he saw a premier, well-financed global leader with a solid 3% yield and a massive order book, all trading at a price that didn't even come close to reflecting its long-term value. He bought when everyone else was pessimistic, and as he put it, the stock took off on schedule, netting him a 68% return.
Look, all these numbers and ratios are powerful tools, but they're completely useless if you don't have the right mindset. The final, and I'd argue most important piece of the Neff puzzle is the philosophy that guided every single decision he made.
This is the Neff creed right here. He didn't join the crowd clamoring for fashionable stocks. He exploited that crowd. He didn't try to buy high and sell even higher, what he called greater fool investing. Instead, his entire game, his whole playbook, was to buy good, solid companies when they were unpopular and misunderstood, and then just patiently wait to sell them once the crowd finally caught on and recognized their value.
And this quote just sums it all up so perfectly. He wasn't trying to hit these dramatic, high-risk winners on every single shot. He was focused on consistency, on just keeping the ball in play, and on letting other, more emotional investors make the unforced errors. That's how you win the long game.
And that leaves us with a final thought to reflect on. Take a look at your own investments through this John Neff lens and ask yourself, are you caught up in chasing fashionable stocks, paying a super high price for some uncertain future hype? Or are you following the path of the value hunter, patiently seeking out solid, unloved companies and buying present value at a bargain price? The answer to that question could make all the difference.
All right, let's jump right in. You know, most investors, they chase what's hot, what's popular, what's hitting all-time highs. But the legendary fund manager John Neff, well, he built his entire career doing the exact opposite. He went shopping in the market's bargain basement, sifting through the stuff everyone else had tossed out. In this explainer, we're going to figure out exactly how he did it.
And that quote, man, it really says it all, doesn't it? Neff's whole philosophy wasn't just about spreadsheets and cold hard numbers. It was about getting your hands dirty, about sifting through the discarded, the overlooked, and the totally unloved parts of the market to find real hidden gems. It's a treasure hunt, really, and the map starts right where most people are too scared to even look.
So here's our game plan for today. We'll start by getting into the right headspace, the contrarian mindset of the bargain basement. Then we'll get practical and look at where to actually find these deals and how to analyze them to see what everyone else is missing. We'll even check out some advanced tactics, pull out some key lessons for all of us, and wrap it up with the ultimate reward you get for thinking this way. Right, first things first. If you want to invest like John Neff, you have to be willing to go against the herd. It's not just a strategy, it's a whole mindset. It's about looking at what everyone else is desperately selling and asking one really simple question. Wait a minute, why? See, Neff wasn't looking for broken companies, not at all. He was looking for good companies that were just having a bad day or maybe a bad month or heck, even a bad year. The key ingredients are all right here. A solid business, the ability to grow its earnings, and a cheap price tag, usually because of some temporary problem. And that cheap price is measured by a low price-to-earnings ratio, or PE. All that really means is you're paying very little for every dollar the company earns. And that, my friends, is the flashing sign of a potential bargain.
So, if that's the what, the next big question is the where. Where do you actually put this into practice? Where do you go hunting for these unloved, undervalued companies?
Neff's favorite hunting grounds were the very places most investors run screaming from. I mean, think about it for a second. The list of stocks hitting their lowest price in a year, the biggest losers of the day, companies just getting hammered in the news, entire industries being called dead. For most people, seeing this stuff is a panic signal. For Neff, it was a shopping list. He knew that buried somewhere in that pile of bad news were solid companies just waiting to be investigated.
And this is it's so simple, but it's brilliant. Whenever Neff saw a good, familiar company pop up on one of those worst performers lists, he had what he called the humph test. It's that little sound you make, that little grunt of curiosity when something just doesn't quite add up. It's not a buy signal, not yet. It's a trigger. It's that moment a problem flips into a potential opportunity and makes you ask, okay, what is really going on here? And is the market totally overreacting?
Okay, so you found a company that's been beaten up and it passed the humph test. Now what? Well, now the real work begins. This is where you have to figure out if there's actual, real value buried under all that negative chatter. This part is about deep analysis, not just a gut feeling.
Let's look at a classic case study here. The insurer Cigna. Back in the late 80s, Wall Street was basically running around with its hair on fire, convinced that massive environmental liabilities were going to bankrupt the entire industry. This is a perfect example of groupthink. But Neff and his team at the Windsor Fund, they took a step back. They looked deeper. They remembered a similar panic over asbestos years earlier that never really played out. And more importantly, they saw that all this noise was completely obscuring Cigna's very profitable and growing managed care business.
And here is the payoff for that contrarian thinking. As those environmental fears started to fade, Cigna's stock just took off, gaining a whopping 54% in 1991. I mean, look at that chart. It didn't just beat the S&P 500, it absolutely demolished the average for its own industry. That's what you get for seeing value where everybody else only saw risk.
And Cigna wasn't some lucky one-off deal. This was his bread and butter. Just look at these names on the list: IBM, General Motors, Chrysler. We're talking about blue-chip household names here. But after big price drops, Neff's fund was right there, ready to buy them at a discount, turning widespread market fear into a massive opportunity.
Want another quick, punchy example? Home Depot. Back in 1985, investors got totally spooked by how fast it was expanding. They worried all the costs would crush profits, and the stock tanked. Neff's fund saw a great, well-managed company and jumped in. The result? A 63% return in about 9 months. It just goes to show you, panic creates bargains, even in fantastic companies.
Now, sometimes the value isn't just hidden by bad news. Sometimes it's hidden by something else, just sheer complexity. So let's get into some of Neff's more advanced tactics for decoding these tricky, special situations.
Check this out. Take Owens Corning. To fight off a takeover, the company went through this wild restructuring. They borrowed a ton of money to buy back their own stock. This left their balance sheet looking, well, bizarre. It ended up with something called negative shareholder equity, which sounds terrifying, right? It means on paper, your debts are bigger than your assets. That phrase alone scared off almost everybody. But Neff looked right past the scary accounting jargon and saw the reality. The debt was a one-time thing, and underneath it all was a world-class company with a great, growing business. The accounting was just noise.
And his creativity didn't stop there. He'd find these backdoor ways to invest, like he'd buy Shell Transport just to get more exposure to the undervalued Royal Dutch Shell than was normally allowed. Or he'd find companies that the market just totally miscategorized. He bought the chemical giant Bayer at a cheap, boring chemical stock price, knowing full well that half its business was actually in the much more valuable and stable drug sector. I mean, this is really next-level bargain hunting.
So this is all great for a legendary fund manager, but what about us? How can we take these big fund ideas and actually apply them ourselves? You gotta know, this strategy isn't without its risks, so it's absolutely crucial to learn from the wins and the losses.
So let's talk about a time when this whole approach went south. It's a really important lesson. The company was called U.S. Industries, and on the surface, it looked great. It was a fast-growing conglomerate, buying up companies left and right, and the growth looked amazing, seemed like a perfect low PE stock. But there was a fatal flaw hiding in plain sight.
And here it is. This is the one question that should have been a massive red flag. USI had bought about 100 different companies across 6 different industries. I mean, seriously, could one management team really, truly, effectively run such a sprawling and diverse empire?
In hindsight, the answer was obviously no. The complexity that looked like a strength was actually its biggest weakness.
The result was a painful 50% loss for the Windsor Fund. And the key lesson Neff took away from this was all about critical mass. USI's many small businesses were just that, small. They didn't have the size or the scale to really dominate their markets and get premium prices. It was a collection of parts that was ultimately way less than the whole. Remember, a cheap stock isn't a bargain if the business underneath it is flawed.
So, to avoid falling into a trap like that, Neff always talked about developing what he called a curbstone opinion. It's basically about doing your homework and answering these fundamental questions before you even think about buying. I mean, look at this list. What's the company's reputation? Is it in an industry that can actually grow? Is the company a leader? And what about the people running the show? Are they smart? It's about starting with common sense business analysis, not getting lost in complicated models.
So when you put it all together, if you do that work, if you brave the bargain basement and really develop that contrarian mindset, what's the ultimate payoff? What's the big advantage you gain?
It comes down to this absolutely brilliant concept he called a free plus. Think about it. When you buy a super popular, high-flying stock, everyone expects good news, so all that optimism is already baked into the price. Any little piece of bad news can make it crash. But when you buy a beaten-down, unloved stock, all the bad news is already priced in. Expectations are on the floor. So when some unexpected good news hits, a new product, a merger, a market turnaround, it can have a massive, outsized positive effect. It's a bonus you literally didn't pay for. It is the incredible upside of having super low expectations.
At the end of the day, Neff's message is pretty clear. Opportunity lives where fear does. By systematically looking for solid companies that are just temporarily unpopular, you can turn the market's pessimism into your own profit. It takes discipline, it takes curiosity, and yeah, it takes a willingness to stand apart from the crowd. So the only real question left is, are you ready to go shopping in the bargain basement?
All right, today we're going to dive deep into the powerful and, let's be honest, often lonely world of legendary fund manager John Neff. We're going to unpack how he built a Hall of Fame career by doing something simple but not easy. Consistently buying unpopular stocks with low prices relative to their earnings, low PE stocks. And maybe even more importantly, how he found the conviction to stick with them when pretty much everyone else was running for the hills.
And that quote right there, man, it just gets right to the heart of it, doesn't it? What Neff is saying is that the real challenge isn't the spreadsheet, it's not the math. It's a psychological war. It's about having the guts to stand apart from the crowd, to buy what feels uncomfortable, and to tolerate that risk of looking like a fool while you wait for your analysis to be proven right.
So here's our game plan. First, we'll get into the contrarian mindset. Then we'll look at how to survive and even thrive during those moments of market mania. After that, we'll break down Neff's actual blueprint for finding value, cover his absolutely crucial rules for selling, and then wrap it all up with some timeless lessons that, frankly, are more relevant today than ever before.
Okay, let's start with the most critical piece of the whole puzzle, the psychology. Neff was convinced that if you don't understand the mindset of a true contrarian, the rest of this strategy is totally useless. It's the key that unlocks everything else.
You know what's so fascinating about this is how it really boils down to a battle between two different fears. On one side, you've got the crowd. They're driven by FOMO, the fear of being left out. They pile into the hot stocks because it feels safe to be with everyone else. But on the other side, you have the contrarian. Their biggest fear? Overpaying. So they deliberately go where no one else is looking, relying on cold, hard fundamentals, not just popular opinion.
But here is a massive, massive warning from Neff. Being a contrarian just for the sake of being different, well, that's just a fast track to losing money. He makes it really clear that there's a razor-thin line between being a smart contrarian and just being stubborn. The goal isn't to fight the market, it's to find those specific moments where the market is fundamentally wrong and you've done the homework to prove it.
And that leads us perfectly into our second section. How do you survive and even profit from those periods of absolute market hysteria? You see, for Neff, these moments weren't a threat. Nope, they were the source of his absolute best opportunities.
This timeline just says it all, doesn't it? History doesn't just rhyme, it pretty much repeats itself, beat for beat. You had the nifty 50s craze, where Neff learned that you can definitely overpay for even a fantastic company. Then the oil frenzy, tech bubbles. The pattern is always the same. A popular story gets pushed to an insane extreme, and common sense just goes right out the window. Neff's genius was just sticking to his principles while everyone else was caught up in the hype.
And this brings us to a really key concept, the inflection point. Think of it as the moment the party ends. It's when the hype finally smacks into the wall of reality and the crowd just panics and bolts for the door. Well, that panic, that is precisely what the patient, low PE investor has been waiting for. It's their chance to swoop in and buy great assets on sale. Neff told this great little story to explain the market's ridiculously short memory. Investors, just like those hunters, they ignore the warnings from last time and make the exact same mistakes, somehow expecting it to work out differently. And it's this predictable cycle of greed and forgetfulness that creates the booms and busts that a good contrarian can really take advantage of.
Okay, so you've got the right mindset. You can spot market madness from a mile away. But how do you actually find the value? Well, that brings us to Section 3, Neff's systematic blueprint, a framework he called measured participation.
So instead of thinking in those rigid, traditional industry boxes, Neff just broke the entire market down into these 4 broad buckets. This gave him the flexibility to hunt for value wherever it was hiding, no matter what Wall Street was currently obsessed with.
First up, we've got the superstars, the A-listers, the highly recognized growth stocks. These are the household names, the popular kids that everybody knows and everybody wants to own.
You know the ones. Think General Electric, Coca-Cola. They're amazing, dominant businesses for sure, but their popularity is also their biggest weakness from an investment standpoint. Because everyone wants a piece of them, their price-to-earnings ratios often get bid up to the stratosphere. Neff learned from the Nifty 50 crash that even the best company in the world is a terrible investment if you pay too much. So he was always extremely cautious here.
Okay, now we get to the real heart of Neff's strategy. This was his happy place, his main hunting ground, the less recognized growth companies. We're talking about solid, growing businesses that, for one reason or another, just aren't on the market's radar.
This is where the magic really happened. You could find a company with growth rates that were just as good as the famous superstars, but they were trading at these bargain basement single-digit PE ratios. Why? Because Wall Street just hadn't noticed them yet. For Neff, this was the perfect recipe, fantastic growth potential at a low-risk price.
Next up are the moderate growers. Neff kind of lovingly called them the solid citizens. These are the mature, steady, and let's face it, often boring companies that the fast money crowd on Wall Street tends to look down their noses at.
Now, these companies, they're not going to set the world on fire with crazy growth. That's not their job. But what they did offer was stability, a reliable return from a super low valuation, and really nice dividend yields. They were like the defensive anchor for the portfolio, and they threw off a steady stream of cash, what he called dry powder, that he could use when other more exciting bargains popped up.
And finally, we have the category where timing is absolutely everything, the roller coaster rides of the market, the cyclical growth stocks.
These are your industries that are tied at the hip to the economy's ups and downs. The whole key here was anticipation. Neff's play was to buy them at the bottom when things looked awful and everyone hated them, usually about 6 to 9 months before their earnings were expected to turn around. Then, as the good news started rolling in and the crowd came rushing back, he would sell right into that strength. The crucial lesson here is don't get greedy. The market knows that peak earnings for a cyclical company can't last, so you have to get out before the party's over.
And that brings us to what Neff himself said was the most difficult, and you could argue the most important part of investing, knowing when to sell. It's a skill that is absolutely fundamental to actually locking in your profits.
Neff's approach here was just beautifully simple. He took all the emotion out of it with 2 crystal clear rules. You sell for one of 2 reasons. 1, the story changes, the fundamentals get worse, and your original reason for buying is gone. Or 2, the stock works. The price goes up and hits the target you set for it way back when you bought it. That's it. Simple as that.
Oh, I love this quote. It's such a perfect psychological gut check, isn't it? Think about it. When one of your contrarian bets pays off big, and you've been proven right, it is so easy to fall in love with that stock. You get that warm, fuzzy feeling. You want to tell all your friends how smart you are. Well, Neff says that feeling, that pride, is the most dangerous emotion an investor can have. It's a flashing red light telling you that your objectivity is gone and it's time to take your profits and find the next opportunity.
So let's wrap this all up. How do we connect these principles to the market we're all dealing with today? Because with more information and, frankly, more noise than ever, Neff's disciplined approach is a powerful way to find that elusive signal.
This slide really sums up the 2 paths you can take. You can be the prospector, right? Chasing hot tips, following the chatter, hoping to get rich quick. Or you can be the prudent investor. You do the hard work. You patiently search through the bargain bin for real value. You're not trying to hit home runs. You're just trying to get on base consistently. And as John Neff pros for decades, over the long haul, that patient, disciplined path is the one that wins the game.
So, the ultimate question that Neff's entire career leaves us with is right here on the screen. In a world that is just drowning in hype and nonstop chatter, his disciplined, contrarian philosophy is more valuable than it's ever been. The challenge for all of us as investors is to figure out how to tune out all that noise, do the actual work, and find our own fundamental signal.
You ever look at the market and just think, this is nuts? You know, when hype totally overshadows profits and investors are so caught up in rising prices they forget what a company is actually worth? Well, the legendary investor John Neff had a perfect name for those times. He called it the silly season.
So how in the world do you cut through all that noise? Well, John Neff gave us a really simple but powerful mantra. He actually borrowed it from politics to make sense of the dot-com chaos. See, for him, it was déjà vu. He'd seen the same euphoria, the same excess before. And this warning, it's the valuation stupid, is going to be our guide today. It's the ultimate reality check, and it's the lens we're going to use to understand one of the wildest rides in market history.
All right, here's what we've got on tap. We're going to break down this whole saga into 6 parts. First, we'll see how market madness is nothing new. Then, we'll go treasure hunting with Neff in the ruins of a market crash. After that, it's the main event, Neff versus Wall Street's darlings. We'll feel the squeeze as he stands firm during a brutal panic. And then, we'll get to the epic comeback, leaving us with a lesson that's just as important now as it was 50 years ago.
Okay, let's set the scene. For John Neff, watching the dot-com bubble in the late 90s was like hearing a song he already knew and didn't particularly like. He'd heard it back in the early 1970s. That was an era all about a handful of so-called glamour stocks that basically sucked all the oxygen out of the room. In both cases, people weren't really buying companies anymore. They were buying a story, a dream of infinite growth, and they were paying an absolutely insane price for it.
And this really sets up a massive clash of ideas. I mean, a real battle of investment philosophies. In one corner, you've got the momentum crowd. They're riding the hype train, fueled by hopes and dreams. For them, price doesn't matter. It's all about what's fashionable. But in the other corner, you have John Neff. He's all about solid fundamentals, sound analysis, and his favorite thing in the world, a low price-to-earnings ratio. This fight right here, this is the heart of our story.
So, when the go-go 60s party ended with a 37% market crash, what did most of Wall Street do? They ran for the hills, licking their wounds. But not John Neff, oh no. He saw a massive opportunity. While everyone else was selling in a panic, he took his Windsor Fund and went shopping right in the middle of the wreckage. See, for a true contrarian, a burst bubble isn't a crisis, it's a treasure map.
Now, you gotta understand this one weird trick that fueled the 60s bubble. It was called Chinese paper. It was a clever but really dangerous game. Here's how it worked. A company, usually one of those big conglomerates, would get a ton of hype. Its stock price would shoot into the stratosphere. Then it would use its own crazy overvalued stock, the Chinese paper, to go out and buy other companies that had real profits but lower valuations. It was like magic, creating this illusion of growth out of thin air. But you know, illusions never last. And here's the key. When that magic trick stopped working, investors didn't just walk away. They stampeded for the exits. They didn't just sell, they oversold. It was a classic case of throwing the baby out with the bathwater. But Neff, he looked past the panic and saw that hidden inside these hated companies were a bunch of perfectly good businesses, now selling for pennies on the dollar. He was betting against the mob, pure and simple. So, did it work? Oh boy, did it work. Take Gulf and Western, one of the wildest conglomerates of the era. Its stock had crashed from $60 down to just 15. Neff jumped in, and by early 1972 he was sitting on an 80% plus gain. That was 4 times what the overall market did. It was proof of concept, right there. Even the biggest train wrecks of a mania can be fantastic investments, if you get the price right.
Neff's early win was a huge boost for his contrarian style. But you know how the market is? Just when you think you've got it figured out, it throws a massive curveball. A new obsession was taking hold. A group of stocks so perfect, so beloved, that the old rules of investing just didn't seem to matter anymore. This was the beginning of the Nifty 50 era, and it was about to become the fight of John Neff's life.
So what were the Nifty 50? Oh, they were the absolute darlings of Wall Street. We're talking about giants like IBM, Xerox, Polaroid,
household names, and the sales pitch was incredibly tempting. These companies are so dominant, so amazing, that you can buy them at literally any price, tuck them away, and never sell. A one-decision stock. And when a huge bank like Morgan Guaranty started buying them, no matter the cost, everyone else just piled in, thinking, hey, if it's good enough for Morgan, it's good enough for me.
Now this is where it gets tough, really tough. Being a contrarian at a time like this is just brutal. As the Nifty 50 shot to the moon, Neff's portfolio of boring, low PE stocks got left in the dust. In 1971, his fund underperformed the market. By 1973, he was trailing the S&P 500 by a painful 10 percentage points. Can you just imagine the pressure? Clients calling, peers whispering, telling him to just give up and buy the hot stocks. It must have been immense.
But Neff didn't blink. He never wavered. And this quote, this just says it all. He basically said, "I'm not the crazy one, you all are." He was absolutely convinced that no matter how long the party lasted, eventually gravity had to kick in. He saw these sky-high prices for what they were, an abuse of common sense that just couldn't last. He just had to be stubborn enough to wait it out. And then, reality came crashing down, hard. The euphoria of '72 gave way to the absolute misery of 1973 and '74. You had Watergate, soaring inflation, an oil crisis. It was the perfect storm. The bubble didn't just leak, it exploded. And when the Nifty 50 finally cracked, they didn't go down alone. They took the entire market with them, triggering one of the worst bear markets in living memory.
This was the absolute low point. You'd think that in a crash, Neff's safer, low PE stocks would hold up better, right? Well, not this time. This wasn't a normal downturn. This was a sell everything, I don't care what it is, panic. There was nowhere to hide. In fiscal 1973, Windsor's value just cratered, down 25%. For Neff and his investors, it was a truly devastating moment.
But you know the old saying, the best time to buy is when there's blood in the streets. And in these moments of pure terror, the biggest opportunities are born. While everyone else was hitting the panic button, Neff and his team were doing what they always did. They were hunting, sifting through the rubble. And that's when they found it, a quirky little electronics store from Texas that would become the foundation of one of the greatest comebacks in investment history.
So why Tandy, of all things? Well, if you look at it, it was a textbook John Neff investment, a true diamond in the rough. You had this company with a phenomenal track record, 13 years in a row of growing its earnings. It was a leader in its field with a proven business model, and yet, because it wasn't one of the cool kids, its stock got absolutely demolished in the crash. It was a fantastic business, on sale at a fantastic price.
Now, here's where things get really interesting. This is where a good investment becomes a legendary one. Neff had this idea he called a free plus. It's like an unexpected bonus, a game-changing development you could never have planned for. And for Tandy, that free plus was the personal computer. Their little TRS-80 computer, sold through Radio Shack stores, became a surprise smash hit. And just like that, this already cheap stock was at the very center of a technology revolution. Okay, so after years of being on the wrong side of the trade, of underperforming, of having the entire world tell him he was a dinosaur, Neff's patience was about to pay off. And not just pay off, it was going to pay off in the most spectacular way you can imagine. The silly season was finally over, sanity was trickling back into the market, and Neff's portfolio of ugly ducklings was about to turn into a flock of swans.
And here is the payoff. Thanks to his team's great research and that completely unpredictable free plus from the computer boom, what Neff hoped would be a solid winner turned into an absolute grand slam. On just one sale of Tandy stock, his fund locked in a jaw-dropping 520% gain. Just let that sink in for a second.
And that was just one stock. The whole fund came roaring back to life. In 1975, as the market was just shakingly getting back on its feet, Windsor went on an absolute tear. Bam! A total return of over 54%, crushing the S&P 500 by a whopping 17 points.
And he wasn't finished. The very next year, 1976, Windsor did it again. Bam! Another monster gain of over 46%. After all that pain, all that time in the wilderness, the low PE philosophy wasn't just proven right, it was completely, totally vindicated.
So let's catch our breath. What an incredible story, right? What is the big lesson we can pull from this whole epic journey? Well, John Neff's battle through the silly season is basically a masterclass for all of us.
It's timeless wisdom on how to handle the two most powerful forces in the market, fear and greed. So here's the playbook. First, know your history. These patterns of fear and greed, they happen over and over again. Second, remember, you can't count on hopes and dreams when things get ugly. They just disappear. Third, you've got to be patient because manias can last way longer than you think is rational. But that's okay, because on the other side of that craziness is where you'll find the best deals. And finally, you need an anchor. For Neff, it was a laser focus on valuation. That's your compass in the storm.
All this brings us to one final big question. John Neff saw these same human behaviors, the same cycles of hype and despair, drive huge bubbles in the 70s and then again in the 90s. So if you look around at the market right now, with all of today's new stories, new trends, and new technologies, where do you see the silly season today?
All right, so picture this. It's the late 1970s, and the stock market is just a total mess. Everybody's freaking out about inflation, crazy high interest rates, and what's going on with oil prices. And while pretty much everyone was chasing the same few hot stocks, this one legendary investor, John Neff, was doing something completely different. He was running a gritty, unglamorous, but totally brilliant strategy he called 4 yards in a cloud of dust. Today, we're going to crack open his playbook from that time and see exactly how he navigated one of the wildest periods in market history.
So here's our game plan for breaking down Neff's masterclass. First, we'll get into his core philosophy. Then, we're going to walk through his biggest bets year by agonizing year. We'll see how he dealt with the pure psychological pressure of being a contrarian, watch him get the last laugh, and then, at the end, we'll boil his whole strategy down into a few key lessons that are, frankly, just as important today as they were back then. Okay, let's set the stage. We're in the late 70s. The market was still licking its wounds from the Nifty 50 crash. You know, where all those popular growth stocks just got annihilated. So investors were jumpy, and all they could talk about were the big, scary headlines. But John Neff? He wasn't reading the headlines. He was looking at the price tags. And that was the million-dollar question, right? The market was totally fixated on just a handful of ideas. So if you just followed the herd, you were almost guaranteed to be overpaying for companies that had already had their big run. Neff's answer was simple. Do the exact opposite. Go where nobody else is looking. Sift through the bargain bin for companies that were totally misunderstood.
The whole thing was built on this one simple, powerful idea. You see, the PE ratio, price to earnings, just tells you how much you're paying for $1 of a company's profits. So a low PE means it's cheap. But Neff's genius wasn't just buying cheap junk. No, he was finding really good companies that were only cheap for a little while because they were out of fashion or the market just didn't get them. It's bargain hunting for quality.
So let's get into Neff's first big, gutsy move during this time. It really shows you just how willing he was to go against the grain. I mean, betting against the most beloved, widely owned companies in the entire world.
I mean, seriously, think about the nerve this took. He sold IBM and AT&T. These were the bluest of blue-chip stocks, the ones your grandparents told you to buy and never sell. But he saw their growth slowing down, getting, as he put it, prosaic. And where did he put that money? Straight into the auto industry, a sector everyone hated, a business everyone thought was on its last legs.
Get this, Neff bought shares in Ford for just 4 times its annual earnings. 4 times. The rest of the market thought the huge car sales in 76 and 77 were a total fluke, but Neff saw something else. He saw that new, more fuel-efficient cars were kicking off a massive replacement cycle. He saw real, durable demand where everyone else just saw a temporary peak. And this is the other half of the magic trick. It's about protecting your downside. While he was waiting for the market to wake up and realize he was right about cars, General Motors was paying him a dividend of over 9% a year. That's the classic get-paid-to-wait strategy. Even if the stock price did nothing, he was still making a fantastic return. But here's the thing, Neff's portfolio wasn't just this one big bet on cars. While that slow and steady thesis was cooking, he had what he called an imagination segment, full of other undervalued companies. And a perfect example was Pizza Hut. When PepsiCo bought them, boom, Neff bagged a quick 100% gain. It just goes to show how a good value portfolio works. You've got your main bets, your workhorses, but you also have these other plays that can give you these spectacular pops.
Okay, so fast forward to 1979, and the market was just bouncing all over the place. It had no direction, it would rally one week, then crash the next. In that kind of chaos, what Neff called dwell time, that quiet period you need for the market to recognize a good company, was almost impossible to find. But Neff didn't get rattled. He just kept digging,
finding companies like these. He bought Delta, which was the best-run airline in a totally chaotic industry. He bought a railroad, Santa Fe Industries, for just 5 times earnings, and oh, by the way, they also owned a ton of oil and gas assets. He even bought Borg Warner, which the market was punishing because it was related to the auto industry, even though only about a quarter of its business was actually selling to car companies. Every single one was a classic Neff play, misunderstood, unloved, and dirt cheap.
And this really shows you he wasn't just buying stocks and, going on vacation. He was actively managing this portfolio. He sold his oil stocks after they ran up 33%. He started buying big, forgotten growth companies like Kmart. He even saw a recession coming and started positioning for the recovery. Now, it wasn't perfect. A surprise rate hike from the Fed hammered his bank stocks, but that discipline was always there.
Now we get to 1980. And this was the year that tested Neff's discipline to its absolute limit. The market wasn't just chaotic anymore. It was in the grip of a speculative mania. It was pure institutional groupthink. And this is where the story gets really good. Because it's one thing to have a strategy, but it's another thing entirely to stick with it when it feels like it's completely, totally broken.
You can almost hear the frustration in his own words here. He called himself a basic grubber. Meanwhile, a tiny group of oil and tech stocks were doubling, and the market was just throwing everything else in the trash. This wasn't just underperforming, it was a psychological war. Just imagine the pressure. Every single day you see these hot stocks soaring, while your portfolio of sensible, cheap companies is going nowhere. It's the same thing we've seen with dot-com bubbles or other frenzies. The urge to just give up and chase what's working is massive. This is the real test of a contrarian.
And look, the numbers don't lie. This chart really paints the picture of just how painful it was. The S&P 500 had a great year, but all of that performance came from the energy craze. Neff's Windsor Fund, full of banks and other stocks that get crushed by high inflation, just got left in the dust. This is the lonely reality of being a true contrarian. When the party is raging, you're the guy standing in the corner, knowing the whole thing is about to come crashing down.
But here's the thing about those kinds of speculative parties. They always end. And in 1981, the music stopped. The mood swung from pure euphoria to absolute panic. And all of Neff's patience was finally and spectacularly rewarded.
And wow, did the tables turn. It was a complete reversal. As all those hot oil and tech stocks from 1980 came crashing back to earth, Neff's portfolio of boring, cheap, sensible companies just roared to life. In just 9 months, his fund beat the S&P 500 by an incredible 18 percentage points. 18%! All that pain from 1980 was completely erased, and then some. The party was over, and his discipline paid off, big time.
And this is where he goes from defense to offense. It's a total masterstroke. Neff didn't just sit on the sidelines during the frenzy. He was getting ready to pounce on the crash. When those high-flying oil stocks plummeted 35 to 50%, he saw their PE ratios fall right into a sweet spot, around 5 to 6 times earnings. And he didn't hesitate. He scooped up almost $80 million worth of them. And he got a little bit lucky, because the takeover battle for Conoco almost immediately gave him a quick profit of over $14 million.
But here's what's so critical to understand. For Neff, this wasn't a mission accomplished moment. His process was a cycle that never stopped. As soon as his bank and transportation stocks got popular again and their prices went up, he started selling them. And he took that cash and rolled it into the next unloved category, which at that point was basic industrial companies. For Neff, the payoff wasn't the end of the game, it was just the signal to start a new one.
So, after all that, after that wild 5-year ride through chaos, manias, and reversals, what's the big takeaway? What are the lessons we can pull from John Neff's gritty 4 yards in a cloud of dust playbook? It's not flashy, but man, is it powerful.
His whole philosophy really boils down to this 5-step process. 1, it all starts with a low PE ratio. That's your ticket to the game. 2, the company has to be growing. It can't be a melting ice cube. You need at least 7% fundamental growth. 3, you want a nice fat dividend yield that protects you and pays you while you wait. 4, and this is his secret sauce, your total return, that's the growth rate plus the dividend yield, should be at least double the PE ratio. And finally, number 5, and maybe the most important, you have to know when to sell. Don't fall in love with your stocks. When they're not a bargain anymore, you take your profits and you find the next one.
And that really brings us to today, doesn't it? This is the question Neff's timeless strategy leaves us with. Because in any market, No matter the era, there are always sectors, always companies that are misunderstood, ignored, and priced like they're going out of business. The challenge, and the real opportunity, is to tune out all the noise, do the actual homework, and have the guts to buy what everyone else is desperately trying to sell. That's the real lesson from the master of the contrarian playbook.
All right, let's dive in. Today, we're cracking open the playbook of a true market legend, John Neff. We're going to follow him and his Windsor Fund through one of the most wild periods in financial history, from the start of the roaring 80s bull market through the historic crash of 1987 and then into the aftermath. Seriously, it's a masterclass in discipline, contrarian thinking, and some incredible foresight. And this quote, "This is the whole ballgame right here. A 41-fold increase. I mean, that's not just beating the market, that's playing a completely different sport." Neff basically says, look at the numbers. The debate is over. So the big question for us is, how on earth did he pull it off? Let's unpack the incredibly disciplined low price to earnings strategy that was his North Star. So here's our game plan. We'll start back in 1982 watching Neff lay a foundation. Then we'll see how it all paid off in 83 and 84. After that, we'll watch him get defensive as the market gets way too hot, which leads us right into the huge climax, Black Monday in 87. And finally, we'll see how his incredible patience was proven right in 1988. Okay, let's set the scene. It's 1982. The Reagan bull market is just revving its engines, and there's this huge wave of optimism sweeping through Wall Street. But John Neff, he's not riding that wave. Nope, he's doing the exact opposite. He's digging in his heels and doubling down on his specialty, finding those out of favor, overlooked, and totally misunderstood stocks. This right here is the heart and soul of his entire philosophy, low PE investing. You know, it's not about chasing the hot tech stock or the next big thing. It's about being a bargain hunter, plain and simple. It's about leaning against the wind and finding solid companies that the market has just tossed aside, believing that eventually everyone else will see the true value. It's that classic idea of buying when there's blood in the streets. This slide just perfectly captures that split between Neff and the rest of the crowd. So in 82, Wall Street was in a full-blown panic about cyclical industries. You know, things like aluminum that boom and bust with the economy. Neff himself said conditions were miserable. But where the streets saw disaster, Neff saw a once-in-a-generational opportunity. Same thing with the banks. Everyone was terrified a recession would sink them. Neff looked past the fear, dug into the fundamentals, and saw strength. He was zigging while literally everyone else was zagging. And listen, this wasn't just some abstract theory. Look at this real-world example, PPG Industries. We're talking about a boring paint and glass company tied to the auto and building sectors that everyone was running away from. Neff swooped in and bought it for 45% below its recent high at less than 5 times its earnings, and he got to collect a sweet 7.4% dividend while he waited. The bet was so simple. What's going to happen when the car and housing markets finally turn around? Well, PPG's earnings are going to go to the moon. And, spoiler alert, they did. Neff even had this great, really visceral name for his most aggressive plays, catching falling knives. This meant he was diving headfirst into the most beaten down, truly hated parts of the market, like oil services. Now, he wasn't delusional. He knew the prospects weren't great, but he believed the price was so low, the bargain was so extreme, that it more than made up for all the risk. It was a seriously calculated gamble on deep, deep value. All right, so by 1983 and 84, this is where the payoff starts. After a year of patiently buying up everything nobody else wanted, the market starts to turn. The spotlight begins to shift, and suddenly all of Neff's unloved stocks are looking pretty good. His contrarian discipline is about to get rewarded big time. And it turns out those falling knives, they landed handle up. In 1983, the whole oil service index jumped over 26%, but Neff's hand-picked stocks did way better. Halliburton was up 32%, Gulf Oil a staggering 70%. And this just kept going into 1984, a year where the S&P 500 was basically flat, up just 1.6%. In that same dead market, Neff's holdings and Royal Dutch were up 14%, and Exxon, a massive 74% gain. I mean, come on, that is a masterclass in buying panic. One of his absolute masterpieces from this time was Ford. The auto industry was still on the outs with investors, but Neff saw a company that had totally revamped its quality and was in really solid financial health. So he bought it at what he called a dirt cheap price, just 2.5 times earnings. And the result? The stock shot up 85% in 1985, completely crushing the broader market's return. And let's just hit pause for a second and really appreciate the long-term result of this strategy.
By 1984, after 20 years of doing this, the Windsor Fund was up over 1,900%. This wasn't just a lucky streak, it was the result of a disciplined, repeatable process that was now heading into the back half of a massive bull market. But then, the whole vibe started to change. By 1985, the bull market was a full-on raging party, and things were getting, as Neff put it, frothy. While pretty much every other investor was chasing higher and higher returns, Neff's discipline forced him to do the one thing that's so hard to do: pull back and get defensive. You can just feel his skepticism in his own words here from 85. The market's climb just didn't feel real to him anymore. It was being propelled by hope, not by solid fundamentals. He was having a really hard time finding the kinds of bargains his entire strategy was built on. He even started to wonder if his edge was gone, if the market was getting too efficient. And this chart right here shows you his caution in action. By 1986, Neff was sitting on a massive 22% of the fund's assets in cash. Now, in a runaway market, that is a huge drag on your performance. It's painful. But for Neff, it was a statement. He was holding on to his dry powder because he was convinced the party couldn't last forever and that a huge inflection point, a dramatic turn, was just around the corner. And that brings us to the climax of the story, the moment all that patient, disciplined, painful waiting was for. In 1987, that inflection point Neff had been expecting finally showed up, and it hit with a force that shook the entire financial world to its very core. Just look at how the pressure builds here. The year kicks off with total euphoria. The Dow breaks 2,000 for the first time ever. Neff calls it a flight from reality. By the middle of the year, he's describing a very fully valued marketplace, calling it another silly season. The market just keeps climbing, hits its peak in August, and then, on October 19th, the floor just completely gives way. Black Monday. The scale of this is just, it's hard to wrap your head around. A drop of 20.5% in a single day. It was, and it still is, the sharpest one-day fall in the history of the market. Total, widespread panic. For almost everyone, it was an absolute catastrophe. But for John Neff, this wasn't a catastrophe. This was the moment he had been preparing for. While everyone else was panic selling, he unleashed all that dry powder he'd been so patiently holding on to. In just 13 trading days after the crash, Windsor went on a shopping spree and bought $751 million worth of stock. It was historic, executed with ice in his veins while the rest of the world was running for the hills. And now for the final act, the payoff. The crash that Neff had so carefully prepared for became the single greatest buying opportunity of the entire decade. His patient, defensive strategy was about to be proven right in the most spectacular way possible. His playbook after the crash was just simple and brilliant. First, he found entire industries that had just been crushed by the panic. He hadn't bought an airline stock in 18 years, but now they were a top target. Then, within those sectors, he only focused on the quality survivors. Companies like American and Delta that had strong financials. Next, he just exploited the fire sale prices, buying them at huge discounts. And finally, he made this key psychological bet that the average person wasn't going to just stop traveling or shopping because of a stock market panic. And the results of that strategy were pretty much immediate. He dove into specialty retail, another area that got hammered. One of his big picks was Circuit City. In 1988, while the market was still just getting back on its feet with an 11% gain, Circuit City stock just exploded, up 115%. This is what happens when you buy at the point of maximum pessimism. The returns can be absolutely off the charts. So let's look at the final scorecard, because the numbers here are just undeniable. In 1988, the year after the crash, Windsor gained an incredible 28.7%, beating the S&P 500 by over 12 full percentage points. And if you zoom out over that whole wild ride from 82 to 88, the fund beat the market by more than 29 percentage points. It all comes back to that first quote, a 41-fold increase over his career. His discipline didn't just protect his investors, it launched them. It was a true masterstroke. Which leaves us with one last powerful question. Neff's entire playbook was built on patience, discipline, and being willing to stand completely alone. So, in today's world, with the 24/7 news cycle, meme stocks, and lightning-fast trading, is that kind of slow, methodical, contrarian thinking more valuable than it's ever been? Or is it just a relic of a completely different era? It's something to think about. Thanks for joining me for this explainer. What if I told you that one of the absolute greatest investors of all time, a real legend, almost lost it all, but then came back to completely crush the market? Well, today we are diving deep into the incredible story of John Neff. This is truly a masterclass in conviction when the entire world is running for the exits. It's a story about staring into the abyss and not even flinching. Let's get right into it. This quote from Neff himself, it's a little nod to an old watch commercial, but it captures the entire drama in one single sentence. It's all about the rugged resilience of his Windsor Fund, right when his proven strategy was under a full-blown assault. Honestly, it's a lesson in perseverance that is so crucial, especially in today's markets, where it's just so easy to get swept up in the fear and the hype. So the big question is, how did he do it, right? How did he manage to hold on when absolutely everything was going wrong? We're going to break this incredible journey down into 5 parts. We'll see how a champion's amazing record led to this brutal, brutal test, then the first glimmers of a comeback, the ultimate vindication, and then finally, the essential lessons that, we can all learn from Neff's trial by fire. Okay, so to really feel the drama here, we have to go back to the peak. We're talking the end of 1988. John Neff and his Windsor Fund were, and this is no exaggeration, the undisputed heavyweight champions of the investment world. They were being celebrated everywhere for their just jaw-dropping performance. I mean, just look at that number. A return of 28.6%, absolutely demolishing the market by over 12 points. Vanguard's own chairman at the time, the legendary John Bogle, called it a superlative record. But here's the thing, this wasn't a fluke. This wasn't achieved by chasing trends or taking these wild, crazy risks. Nope, it was the result of a disciplined, almost stubborn philosophy. See, Neff was a master of what's known as low PE investing. Think of it this way. He was basically a thrift store shopper in a world full of luxury boutiques. He was always on the hunt for hidden gems that everyone else had just completely overlooked. He hunted for good, solid companies that Wall Street had basically tossed in the bargain bin, believing that eventually the market would wise up and recognize their true value. But you know how these things go. The moment of greatest triumph was also the exact moment the storm clouds started to gather. The very strategy that had made Neff a star was about to be put through the ultimate test. For the next 2 years, it felt like everything that could possibly go wrong did. Now, this is where it gets really interesting, because this shows where Neff was digging for gold. While the rest of the market was running away from banks, car companies, and basic materials like they were on fire, Neff was running towards them. He was seeing incredible value where literally everyone else saw disaster. 1/3 of the fund in commodity cyclicals, over 1/5 in autos. I mean, this was a massive defiant bet against the crowd. And at first, boy, was it brutal. The fund started to lag badly. And this slide, it shows the perfect storm that was brewing against him. That huge bet on autos, it soured. His cash position, which he held for safety, it hurt him as the market just kept rising. His commodity stocks were just dead money. And the market itself was in what Neff called an adrenaline phase, just chasing glamour stocks while totally ignoring his boring, ordinary merchandise. This slide right here perfectly captures the psychological war that Neff was fighting. On one side, you had this screaming chorus of Wall Street, saying banks are doomed, a hard recession is a certainty, avoid these stocks at all costs. And on the other side, you had Neff, just calmly looking at the data, identifying what he called the good guys with strong capital who could weather the storm, and believing in a soft landing. It was a total clash of worldviews. You can just feel the pressure in Neff's own words. He felt completely isolated, like he was the only sane person in the room, sticking to his principles while everyone else seemed to be losing their minds. You can almost feel the weight on his shoulders, this immense pressure to just give up, abandon his strategy, and join the panicking crowd. But he refused to get whipsawed by fear.
So the big question is, did he break? Well, let's jump to 1991, because after 2 long, agonizing years of underperformance, the tide, it finally began to turn. The market was slowly, and I mean painstakingly, starting to separate the truly broken companies from the merely unloved ones that Neff had bought.
This timeline really lays out the emotional roller coaster Neff and his investors were on. I mean, 1990 was the absolute bottom, the point of maximum pain when his core holdings were just getting punished. But then, by 1991, his good guys were stirring. They were showing signs of life, and the fund clawed its way back to nearly match the market. That set the stage for the real bounce.
And here it is, the first real proof that his lonely marathon was paying off. Suddenly, the very same financial stocks that had been dragging the portfolio down, they became the powerful engines of its recovery. Bank America shot up 57%, Golden West Financial 55%. It was the first powerful signal that his analysis, after all that pain, was actually sound. But there was one massive, glaring problem. It was casting a huge shadow over this entire recovery. While most of his financial picks were roaring back to life, his single biggest holding, Citicorp, was in an absolute nosedive. This was the real moment of truth. His biggest bet, Citicorp, was in total freefall. The company eliminated its dividend, a terrible sign, and the stock was down a gut-wrenching 50% from where he'd bought it. Even Neff had to admit they'd miscalculated the damage from bad real estate loans. Now, most investors would have cut their losses and run for the hills. But Neff, he held on, still believing in the company's underlying strengths.
And this, my friends, this brings us to the glorious payoff. This is the moment every value investor lives for. That moment when all the noise dies down, the fear subsides, and the market, as Neff would say, finally comes to its senses.
And when the market came to its senses, oh boy, the returns were explosive. His international pick, British Steel, a company nobody wanted, it rocketed up a staggering 151% in 1993 alone.
And what about the Dutch electronics giant Philips? He saw that its hidden gem, the Polygram music unit, was worth almost the entire company's stock price. So, in essence, he was getting a massive global electronics company for free. The result? A 90% gain. Unbelievable.
And remember those original good guys that caused so much heartache? Well, Bank America, one of his core holdings, ultimately delivered a spectacular 159% return. The conviction paid off in a very, very big way. And this slide right here tells the final triumphant story. Over those 2 years, the Windsor Fund returned nearly 50%. That's almost 3 times the S&P 500. The entire painful multi-year ordeal was completely and utterly vindicated. So, okay, beyond the incredible numbers, what's the real lesson here? This isn't just a story about stocks and returns. It's a powerful lesson in investment psychology and the nature of real conviction. What are the key takeaways from this epic saga? Well, if you're ever going to be a contrarian investor, someone who goes against the grain, you have to understand this 3-step arc. First, you will be tested, and the market will punish you for being early or just for being different. Second, you must have the patience for the emotional frenzy to end. And third, you have to have the faith that if your analysis is sound, fundamentals will always, always win in the long run. So here they are, the final hard-won lessons from the master himself. He taught us that the greatest opportunities are born in the ashes of panic. He proved that you don't have to be perfect. Remember, Citicorp was a miss, but 7 of his 8 other good guys came through spectacularly. But maybe most importantly, he showed us that true conviction isn't about being stubborn. It's about having the quiet discipline to stick to your principles when the world is screaming at you to do the exact opposite. And we'll end with Neff's ultimate thesis. It's such a powerful reminder that in the long run, markets are a weighing machine, not a voting machine. They weigh the actual underlying performance of businesses. And the question he leaves us with is this. In a world of constant noise and instant gratification, do we have the patience and the discipline to let the fundamentals win? Hey everyone, and welcome. Today we're diving into the mind of a true Wall Street legend, John Neff. For 31 years, he ran a fund that absolutely crushed the market, pretty much by zigging when everyone else was zagging. We're going to break down his playbook, using his own words, to see how he found treasure in what looked like the market's trash heap, especially during that crazy dot-com mania. Ready to think like a contrarian? Let's jump in. Right off the bat, Neff hits us with this powerful truth. You know how it is. It's so tempting to look back and say, oh, if only I'd bought Amazon back in '97. But that's just not how it works, right? every single day that clock resets. We can only work with the prices we have today and the information we have today. It's the ultimate investor's dilemma, and how Neff solved it is really what this is all about. So that brings us to the big question, really. When everyone is chasing the same handful of hot stocks, and hype is absolutely everywhere, how do you keep your head on straight? How do you build a strategy that actually puts the probabilities on your side? Well, for John Neff, the answer was simple. You look where nobody else is even bothering to look. Okay, so to really get what Neff was doing, we first have to understand the problem he was staring down. So let's hop in the time machine and go back to June of 1999. The dot-com bubble was in full swing, and from where Neff was sitting, the market was stretched to its absolute breaking point. All right, this number right here, 28. This is the key to everything. In 1999, the market's PE ratio hit 28. Think about that. It means people were willing to pay $28 for every single dollar of a company's annual profit. For a guy like John Neff, who'd seen it all, he said this was, hands down, the most expensive market of his entire career, a huge flashing red light. And this chart? Man, it just perfectly illustrates the danger. This kind of extreme valuation wasn't totally unprecedented, but the other times it happened? Not so good. Absolutely terrifying, actually. The market had only gotten above 20 times earnings on 2 other occasions in his memory. And what happened? Both times, the market just folded, dramatically. History was screaming a warning. So here's the billion-dollar question. I mean, look, paying a high price for a stock can make sense if you're expecting some insane growth. But Neff, he actually did the math. He saw the profits for the entire economy growing at this sluggish pace, maybe 3–4%. So you got to ask yourself, does it make any sense to pay a premium price of 28 times earnings for that kind of slow lane growth? To Neff, it was just plain financial suicide. And this gets us to a really core idea in Neff's whole philosophy: reversion to the mean. It's this really simple but powerful idea that things just don't stay at extremes forever. Trees don't grow to the sky, and these super high growth companies can't keep up that pace indefinitely. Eventually, gravity kicks in, and they come back down to a more normal, more sustainable level. And this quote, wow, it's from Lou Gerstner, who was the CEO of IBM at the time, and it just perfectly captured what was going on. While the public was completely mesmerized by all these new dot-com darlings, he saw them for what they were, just these temporary flashes of light, about to get totally wiped out by the coming storm of real competition. So look, Neff wasn't just pulling this out of thin air. He had this really clear 2-part thesis for why the whole dot-com party was going to end badly. First off, the internet. It wasn't some secret club. The biggest, most powerful companies in the world, the Fortune 1000, were all coming online, and they had the money and muscle to dominate. And second, you had the insiders, the founders, the VCs, all sitting on these massive paper fortunes, just counting the days until they could cash out. So you've got this massive wave of selling about to hit the market. Who's going to be left to buy? A really good question. Okay, so if the hottest part of the market was basically a minefield, where on earth did Neff find anything to buy? This right here is where you really see his contrarian genius shine. He went looking in the unloved, the ignored, and yeah, the downright boring corners of the market. He used this framework, he called it measured participation, and he basically broke the whole market down into these categories. And you know what's absolutely fascinating? In the middle of that 1999 bubble, he found exactly 0, zip, nada in the highly recognized growth category. The very place everyone else was throwing their money. All his opportunities were in these other, less glamorous spots. All right, so let's start with his first bucket, the solid citizens. I love this analogy. Think of these like the Toyota Camrys of the stock market. They're not flashy, they're not going to turn any heads, but they are incredibly reliable. They're established businesses that just get the job done, year in and year out. So what did these solid citizens actually look like back in '99? Well, for one, you had REITs. Companies that own actual buildings. While everyone else was obsessed with the virtual world of the internet, Neff saw incredible value in the physical world of offices and apartments. They were being ignored, and he projected a 16% return. And then you had banks. They were seen as old and boring next to the dot-coms. So their stocks were dirt cheap, trading at low PE ratios and paying out these juicy dividends. It's classic Neff, right? Buy what's boring and unpopular. Okay, so let's move on to his other favorite hunting grounds. These are areas where growth is either just completely overlooked by the market or it's tied to those natural boom and bust cycles of the economy. This is really where a true contrarian earns their stripes, buying stuff when things look the absolute bleakest. And man, his bargain hunt led him to some seriously unpopular places. You had home builders, totally ignored, trading at this ridiculously low 5 to 7 times earnings. Airlines, they were just coming off this nasty price war that scared everybody away, so they were in the bargain bin too. And petroleum refiners were getting crushed by low profit margins. But Neff saw a simple truth. People will always need houses, flights, and gasoline. He was convinced the recovery was, as he put it, almost inevitable. So this table, it really just puts it all together, doesn't it? Just look at the common themes here. Low prices, high dividends, and being completely off the radar of the cool kids on Wall Street. So you have the average investor over here throwing money at tech companies that had never even made a profit, and then you had Neff quietly buying up real businesses, banks, buildings, and oil refineries that were profitable and cheap. It was like they were investing in 2 completely different universes. You know, it's one thing to have a strategy on paper, but it's a whole other ballgame to actually have the guts to stick with it when things get crazy. And to really get how Neff managed that, we need to dig into this powerful metaphor he used to describe his entire career. So late in his career, Neff goes on this rafting trip down the Colorado River. And he had this epiphany that navigating the wild, unpredictable river was the perfect analogy for navigating the stock market. In both, you've got risks that you can manage, sure, but you can never completely eliminate them. And he drew these incredible parallels. There was this one rapid called Hermit, super short, super scary. And he was like, yep, that's the 1987 crash. Then there was another one, Waltenberg, which was less violent but went on forever, just like that grueling bear market from 1980 to 81. His point was that every challenge in the market, just like every rapid on the river, has its own unique personality. And this is where it gets really good, and honestly, a little weird. When the raft was about to hit a big wave and possibly flip, the guide would scream at the top of his lungs, "Suck rubber." It was a simple command: pull your feet up into the raft so you don't get crushed. And for Neff, this just became his ultimate investing mantra. It's not just about finding winners, it's about knowing when to suck rubber, when to sell, take your profits, and get out of the way of disaster.
Okay, so we've seen the theory, we've seen the strategy, and we've seen the philosophy. But the big question is, did it actually work? Well, let's look at the numbers, because the results of Neff's disciplined, contrarian approach, they're just stunning.
So check this out. Over his 31 and a half years running the Windsor Fund, this was his total return. That's over 5,500%. To put that in perspective, if you had given Neff just $1 back in 1964 when he started, it would have turned into almost $56 by the time he retired. It's just a monumental figure. And this chart really shows you the how. It wasn't one lucky bet. Year after year, his fund delivered an average return of 13.7%, which was way ahead of the S&P 500's 10.6%. That consistent edge, that little bit of outperformance every year, compounded over 3 decades, is what gets you to that massive total return that more than doubled the market. And that, of course, brings us to today. I mean, Neff's playbook was an absolute grand slam in his time. But what about now? In our world of AI, meme stocks, and crypto, so is a strategy like this, buying boring, cheap companies, is it just a dinosaur? Or in a market that feels crazier than ever, that feels more like a casino, is this kind of discipline the only thing that can actually save us? That's the question Neff's incredible legacy forces every one of us to confront.